Good morning, everyone, and welcome to our inaugural Trends from the East Conference, a closed event aimed primarily at Renaissance Capital's institutional clients worldwide. To quickly introduce myself, my name is Edward Sabi, Head of South African Equity Sales. With developments in China, an important region impacting investment decisions for all of us across emerging markets, but maybe more importantly for us in South Africa, just given the sectors which drive our markets. We have aimed to put together an interesting and diverse group of experts on the region to give us insights and value from what they see on the ground. With Renaissance Capital's focus on the EMEA region, and with core expertise in frontier economics, Africa, and the global resources sector, we are confident that through our network, we can introduce you to very useful contacts that can give you valuable insights and the ability to interact with people that you potentially would not do so through your normal course of business. Our aims with Trends from the East going forward is twofold. Firstly, we are going to aim to make today an annual event held at the beginning of every year. Then on top of that, given it's a virtual format, we would like to set up further interactions with experts in their fields throughout the year, so please watch this space. Finally, to mention that the primary reason for setting up this conference was in response to our institutional clients' request for such an event. We would therefore like to thank you for all the suggestions and to please keep the dialogue going as to whom you would like to hear from or which specific themes to investigate. This way we can ensure to keep things relevant and topical for you. While the focus of the next day and a half is on the macro, bulk, commodities outlook, the development of the hydrogen economy, and how China can influence development on the African continent, there are so many more topics we can speak to, and we look forward to your suggestions. We hope you find the conference worthwhile and enjoyable, and we look forward to those interactions. Without delay, let me hand over to Dan Salter, our Head of Research and Equity Strategy, to take us through his emerging market outlook. Over to you, Dan.
Thank you, Ed. Good morning and welcome to our first Trends from the East conference. I'd like to start off with a quick recap of where we are now in the emerging markets rebound. Markets are moving quite quickly, so it's worth catching up, I think. We're now 43 weeks in and we're up 85% since the lows of the 23rd of March. We're up 20% since our last conference, our 25th anniversary conference in mid-November, and we're actually up 12% since we published our year ahead outlook just over a month ago now. So EM is doing very well. It's now just within 10% of our year-end target for MSCI emerging markets of 1,513. So we think the pace of the rally ought to slow a little bit from here. Doesn't mean it will, but we think it ought to slow a little bit from here. If we benchmark the rebound to other emerging market rebounds following big sell-offs, we've benchmarked the last 5 major EM collapses here. We're at the higher end of the 23 to 87% range that we should be at. So on the face of it, we're still within that range, but we're quite a bit above the average, which is plus 54% at this 43-week stage. But of course, it's actually a lot better than that. Emerging markets pushed through their pre-crisis peak back in November, and they haven't looked back since. We're now 22% above the first quarter 2020 pre-crisis peak. And regaining the pre-crisis peak typically took several years to achieve in previous rebounds. So this has clearly been a very rapid turnaround for emerging market equities, propelled, as we all know, by the record amount of global stimulus out there, and the success, we think, in tackling the virus in China, Korea, and Taiwan, which between them make up 2/3 of the emerging market index. So emerging markets, developed markets, and the US all now trading well above their pre-COVID peaks, but within EM, as we see here, that's been primarily an emerging Asia story. Emerging Asia 34% above its first quarter 2020 pre-COVID peak, but EMEA still 9% below, and Latin America 21% below its peak. Frontier as well, still trading 2% below its peak level. So there is certainly catch-up potential given the right market conditions, we think, in EMEA, Latin America, and potentially in Frontier. If we look at emerging markets in more detail, as we've said, it's very much a story of the East Asian trio, Taiwan, Korea, and Taiwan, all up 35 to 50% from their first quarter 2020 pre-COVID peak levels, versus the markets on the right-hand side, which have still got catch-up potential. And in our view, that's been driven, at least in the preliminary stages of the rebound, by what we call the resilience trade, the resilience story. Those countries on the left-hand side with robust finances, fiscal capacity, fiscal room, and low yields with which they can stimulate their economies, and an ability to tackle the coronavirus in many ways better than their developed market peers. So that's Korea, Taiwan, and China, between them 2/3 of the EM index. But on the right-hand side, you've got some of the smaller emerging markets which have missed out on big picture flows to date, or perhaps riskier macro stories, or the commodity space. So you're talking about Turkey, Russia, Brazil, Egypt, Pakistan, all between 15 and 30% off their pre-crisis peak still. South Africa, roughly in the middle there, basically flat versus its pre-crisis peak in dollar terms. The other drivers being clearly at the sector level, the tech and healthcare angle. Again, perhaps resilience, you might call it, or growth in a no-growth world. You've got IT, consumer discretionary, communications leading well above their first quarter 2020 peaks, whereas on the right-hand side, you've got the more economic sensitive sectors plus financials generally lagging in the rebound so far. But we think the drivers now are starting to change, and that resilience trade is starting to become something of an old story, and we're now moving into a new phase of the rebound. There are several reasons for that. The first reason is that flows are returning to all the major EM asset classes. They returned first to hard currency debt as early as April, and you've seen 13% of assets under management return to emerging market debt, emerging market hard currency debt since then. Local currency debt turned in July. You've seen about 11% of assets return to local currency debt funds since then. Emerging market equity in August, and you've seen about 4% of assets return to emerging market equity. And Frontier turned last of all, as you would expect, in December, and you've since then seen about 2% of assets return to Frontier equity funds. Why does this matter? It's important, we think, because it makes government and corporate debt rollovers much easier. It allows IPOs to take place, and it allows companies to raise capital. It helps currencies in emerging markets to appreciate, and generally makes that resilience story a lot less important, we think, in emerging markets going forwards. We'd also argue that emerging market equities are looking pretty under-owned. We've seen zero net money going into emerging market equities over the last 10 years, since 2010. That's the red line at the bottom here, which looks at cumulative flows into different asset classes over the last decade. So emerging market equities have missed out on a decade of inflows into emerging market fixed income and plenty of inflows into US equities. And of the inflows that we have seen over the last decade, 70% of those inflows have gone into passive funds. Over the last 5 years, it's been over 80%. And the point we're making now is that when passive money comes into emerging markets as it is, it tends to lift all boats. And the biggest delta that you see is actually on those countries which have lagged to date, or where you were worried perhaps about funding, or had higher interest rates, or have currencies that are undervalued and can move upwards. Frontier, the pink line here, has seen major outflows over the last 5 years. That's turned in the last few weeks, but the asset class is still somewhat compromised by the changes to the index, which is making it a lot less liquid asset class than it was a few years ago. If we look at investor allocations to emerging market funds as a percentage of the allocation to global equities, it's been falling quite significantly over the last 5 or 6 years. It's come down from 13% in 2013 down to about just below 8% currently. And that's in a world where emerging markets' share of global GDP has continued to increase, as we can see from the bottom right-hand graph. So we think that investors are under-allocated still to emerging market equities, and that reversing that trend could take several years fully to reverse. So flows is the first trend. The second major trend we see is the dollar. This graph shows you the relative performance of emerging market equities to developed markets. That's the red line, versus the performance of the dollar. That's the dotted black line, going back almost half a century. And what you can see is that they've been almost perfectly inversely correlated over that time period. And there's generally a 7 or 8 year cycle of emerging markets out or underperforming on the back of the dollar, doing the opposite, going all the way back to the Latin American credit bubble of the 1970s, which Volcker brought an abrupt halt to in the early 80s. We've just come out of 9 years of emerging market equities underperforming against a backdrop of a relatively strong dollar. So timing-wise, we think the cycle is overdue a change, and that although the dollar's sell-off in recent months is probably a bit too fast to be sustained, we'd be happy to see a couple of % a year of dollar weakness versus major global currencies, which we think is enough to allow emerging market equities to outperform developed market peers. Our in-house REER model is suggesting that emerging markets are still slightly cheap, not hugely cheap, but certainly not expensive. And it'll be very interesting to see what today's panels say about the Chinese currency going forwards, as we think this is going to be important for the overall EM currency space. Which currencies, which emerging market equity markets could benefit from a weaker dollar? The graph here looks at the beta and correlation of different emerging markets to a weakening dollar, and it tells us to look at Central Europe, Brazil, South Africa, Peru, Russia, Turkey, Korea, and Mexico if the dollar is going to continue to weaken. Most of Asia has tended to lag when the dollar weakens, with the exception of Korea and to a lesser extent Indonesia. And in a weaker dollar environment, you definitely want to avoid the dollar-pegged GCC countries. At the sector level, dollar weakness has tended to favor materials, financials, energy, and real estate, and tended not to favor healthcare, IT, communications, and consumer sectors. So a clear message at the sector level to look more at economic sensitives. So that's the second trend, the dollar. The third theme we think investors need to look at is economic acceleration. We do expect still a decent global economic rebound this year as vaccines roll out and economies reopen, but we're cautioning that the first quarter could still be surprisingly weak, particularly if governments choose to keep restrictions in place longer than they might otherwise have wanted to, as they seek to avoid further waves of coronavirus while they're still rolling out the vaccination programs. And you can see lots of headlines in the UK at least about perhaps tightening some of the restrictions on travel, etc., until the vaccination program is further advanced. But nevertheless, we do expect a global rebound over the course of the year. And emerging market growth accelerations tend to be very good for emerging markets outperforming developed markets. We can see here on the x-axis the acceleration of emerging market economies versus the y-axis being the relative performance of EM versus DM equities. And there's a 90%, 9 out of 10 hit rate of emerging markets outperforming when emerging market growth is accelerating. So we think that will be the case again in 2021. Which markets and which sectors to look at when growth accelerates? Russia, Thailand, Colombia, Peru, Korea, and Turkey. And at the sector level, consumer discretionary, IT, materials, and energy. With an acceleration in global growth, the commodity theme is also important. And that is supported by the impact of a stronger Chinese currency on China's dollar GDP creation. And this graph here looks at that dollar GDP creation from a sample of Asian countries dominated by China, which is the red bar there. And what we can see here is that using IMF forecasts, China's dollar GDP creation for 2021 is likely to return to record levels. The IMF is expecting about $1.6 trillion of GDP creation out of China, back well above previous peaks. And actually, if the Chinese currency stays at current levels, it could be even higher, well above $2 trillion. The IMF is assuming 6.8 for the renminbi against the dollar in 2021. So again, for the panels later, it'll be very interesting to see what they say about the commodity intensity of China's growth going forwards. To try and keep on track in terms of timing, I'll run through these graphs as quickly as we can do. On valuation, is emerging market equity expensive or not? All markets globally have re-rated. EM is no exception. Emerging markets now trading on a 12-month forward PE of 16.2. That's a 40% premium now to the 10-year average of 11.4, and valuations have exceeded those at the 2008 peak. But at the same time, the graph on the bottom right shows you how much emerging markets bond yields have come down over the last decade. They've halved, and that we think justifies much of that EM re-rating. If we look at the EM discount to developed markets, it's now 22% discount versus MSCI World, which is actually roughly in line with the 10-year average of 24%. So we're not saying that EM valuations are particularly extended versus developed markets, but developed markets as a whole are fairly expensive. MSCI Frontier is trading on a 12-month forward PE of 12 times. That's a near record 26% discount to MSCI emerging markets as a result of Kuwait's transition. So Frontier looking pretty cheap, but the asset class constrained by a reduction in the number of liquid markets out there. At the country level, almost all of emerging markets have re-rated, but that's been led by Asia, which is traded at a 50% premium to the 10-year average. EMEA's premium is just 20%, and Latin America hasn't re-rated at all. So you've got countries like Mexico, Malaysia, Brazil, Greece, South Africa, Egypt, and Turkey, which are all still trading cheap versus their history. The final thing we want to look at in terms of valuation is the idea of emerging market equities as a source of yield. And we're finding now that international fixed income investors are coming to us, as well as local investors, saying we want to look at our equity markets more closely. We used to look at fixed income, but now we want to look at emerging market equities. And why is that? Well, the reason for that is that the dividend yield is now higher than the local 10-year bond yield in just over half of EM countries. It was just 7 in 2015. It was just 3 in 2010 with a slightly smaller set of countries. So the numbers increased dramatically. And what that's meant is that you've got international investors looking at emerging market equities for yield, and you've also got local investors becoming much more important. So some examples of that. In Brazil, you saw 1.6 million new active investors over the course of 2020. In Russia, you saw 5 million new investors enter the equity market in 2020. In Turkey, 800,000. In China, 18 million. And in India, the largest local brokerage now trades more per day, or executes more trades per day than Robinhood does in the States. So you've seen this big increase in the activity of local investors, which we think is going to continue. And we can see here that the idea of countries where the dividend yield was higher than the bond yield tended to outperform quite nicely over the last decade. So to sum up, the key themes we're looking at. Firstly, dollar weakness and emerging market equity strength tend to go hand in hand, historically over a 7 to 10-year cycle. The second point is dividend yields are now exceeding local bond yields in over half of emerging markets now, and term deposits are exceeded by the dividend yield in about 2/3 of emerging markets. The third point, lackluster flows to emerging market equities over the last decade show a potential for significant reallocation to emerging market equities from international investors, which we think could take several years to accomplish. The fourth point, weaker dollar over the coming few years means that investors should move up the risk curve, and we think they should rotate out of those defensive, resilient Asian stories towards some of the cheaper currencies, cheaper equity markets in Latin America and EMEA, and that financial stocks could continue to perform a bit better going forwards. A stronger Chinese currency, good for dollar GDP creation from China, good for the commodity story, so interesting to hear from our panelists about that later today. And the final point here being that frontier equities are looking particularly cheap given the transition of Kuwait. Two final graphs. Over the long term, growth does matter. On the x-axis here, we look at the annualized dollar GDP growth of different emerging markets over the last decade. And on the y-axis, we look at equity returns in dollars annualized over the same period. And there's a very strong link. So growth does matter over the long term. So you might want to reallocate over the next 3 to 6 to 9 months to those economic rebound stories, those cheaper currency stories. But over the next decade, we think you still want exposure to those growth compounders which can compound GDP growth in dollar terms. And that's likely to give you that return as an equity investor. I'll leave you here with the risks. There are plenty of risks out there, as we all know, but we're happy to talk to them one-on-one, or we'll leave that slide for you. And if you want to look at in more detail at our views, we've got 2 major reports which we published late last year on emerging market equities and emerging market economics by my colleague Charles Robertson, and those are available from your salesperson. I will wrap up there, stop sharing my screen, finish the presentation, and hand over to the next panel. Thank you very much indeed.
Ladies and gentlemen, thank you so much for joining us this morning. We are going to be introducing the new development bank and looking at its impact on Africa, on South Africa in particular. But I have to admit, I'm going to hijack this session and look in detail also about some of our views on what's going on in the South African economy, how China is working with that more broadly. So I've got two amazing speakers, which I'm delighted to introduce, and I'm going to give a very potted version and not spend as much time on their education as I should, given that they come from South Africa, both of them, and I know that's very important. We've got Leslie Masdorp, who's the CFO of New Development Bank, and his CV, which I am reading slightly to the left here, he's been everywhere. Bank of America, Barclays Capital, Goldman Sachs advisor. A fantastic experience on the sell side in investment banking. But I'm fascinated also by the experience he had 20 years ago at the Department of Public Enterprises, working on privatization and restructuring. And we were just having a chat a few minutes ago about some of the issues that were already apparent back then that he was working on. So, I mean, full range of experience. And now CFO of New Development Bank, which is the BRICS Bank, which has been lending billions, and we're going to hear more about that in a moment. And we've also got Martin Davis, Dr. Martin Davis, who I saw present nearly a decade ago on China and Africa, and I thought this is annoying. He is so very, very good, but it was a pleasure to watch him, and it was a pleasure to hear him speak, and I'm delighted that we've got him here now. He's now at Deloitte Touche, and he's the managing director of emerging markets and Africa there. He's set up Frontier Advisory. He's got a wealth of experience. What's interesting about them both is that they were young global leaders. But now, between the three of us, we've got something like 75 years of experience in emerging markets. So I'm going to try and bring that to you. What I'm going to do is very briefly go through a quick slide, a few slides on how we are looking at the big picture. And I'm just using this as a frame for this 60 minutes that we've got to chat. As most regular readers will know, I'm of the view that the tracking of US and German bond yields, the tracking of Japan with quite a long lag, about a 17-year lag, continues and will continue for the next 10 or more years. The red line is Germany, the blue line is Japan, and what it's showing you is that if this relationship still holds, that's been working since the global financial crisis, we're going to see German negative yields for the next decade, and I would argue US Treasury yields at between 0 to 2% for the next decade. That is a result of the big debt loads in the West and the high savings of aging societies. What I think it's going to do is lead to a big bid for yield. We've been talking about this since about May last year, and we've been arguing that we would see a bid for emerging markets. And the yield on emerging market debt would fall from what was normal, 12% in dollars 20 years ago, 6% in dollars 10 years ago, 4% a year ago, and we think it's continuing to fall. When Peru issued a 100-year dollar bond just a couple of months ago, after a week in which they had 3 presidents in 1 week, but they could issue a 100-year bond at 3%. I think that's indicative of the bid for yield that we're seeing in EM, which is obviously great news for a place like South Africa. But people are worrying about debt. The massive budget deficits we're seeing in places like Brazil to South Africa and further afield is worrying. So what I'm showing here is a chart of interest payments as a percentage of GDP and interest payments as a percentage of budget revenues along the horizontal. And top right, nearly top right, you've got Zambia already in default. Egypt, though, right next to it in terms of these metrics, but with an IMF deal, and the markets are confident and loving that debt. South Africa is on the left-hand side. It's about 5%. Interest payments are about 5% of GDP and under 20% of revenues. So it's certainly not in the scary group, but you as well as me are worried that it will get there. And I'm quite keen to draw out to what extent the new development bank might help keep those payment costs low. Big picture, there's a debate about commodities, there always is. I'm of the view that we have these 10-year cycles of very high prices. We saw it in oil between 73 and 84. We saw it again in oil between 04 and 14. And those high prices tend to then lead to a big rise in new supply, which crushes commodity prices. What I think we've seen since March, April last year is the Chinese use a stronger currency to bid up, to stockpile everything from wheat, which Dan just mentioned in his presentation, and corn, through to iron and so on. And we are seeing then a rise in commodity prices. My base case is it doesn't go much higher than this. And as a result, my base case is that the Rand gets to roughly fair value, which is about 13.5, 14 to the dollar, but doesn't go much stronger than that unless I'm wrong on commodities. So that's the big picture. We're going to have a bid for yield. We're going to have a bid for EM, which we are seeing in play already. I suspect inflation stays pretty low in emerging markets from now on. And the debt burdens, I think, are manageable because of this flow of capital from the US in a less protectionist America. The flow of capital comes to emerging markets again. So I'm going to stop presenting at that point, and I now would like to say, right, that's my framing of the big picture. I want this to be an argument. I want this to be a debate, and I'm trusting Martin now to present a few slides where he's going to outline what have I got wrong? What am I missing? What are the other alternatives? So Martin, over to you.
Charlie, thank you very much, and thanks very much to Renaissance Capital for the kind invitation. Let me just begin by just painting some thoughts and some intentionally provocative ones, Charlie. We can get to the detail of how South Africa fits into the broader sort of continental narrative. But I put some slides together yesterday on, in line with your conference title, on trends from the East. And I think something quite profound has been happening in our continent in recent times I'd like to talk to. Firstly, we talk about Africa as if somehow we have some sort of coherent interest, and I strongly disagree with that. Africa is integrating, but large swathes of Africa are integrating somewhere else, and just hear me through on this one. So I've been, as you alluded to, Charlie, I've been very fortunate to spend a very long time in China back in the 90s and observing and partaking in this mega play that has been the mega trend of the last generation has been China's engagement of Africa. It started in October 2000 at the first China-Africa summit, and every 3 years there's been iterations thereof. But it's fairly clear to see is that, I mean, a sort of causation and correlation here is that decisions made in Beijing provide far more impetus for growth than decisions made in African capitals, I'm sad to say. And this underpinning of sort of African growth, or pretty much any commodity-driven economy, I think, has been certainly the story of the last 20 years. And this applies to solid commodity exporting economies in our part of the world, of course. This is sort of the geopolitics of it. And we've seen, this is an Economist, a cartoon that appeared in The Economist a while back, I think it was 3 years ago. But that's not my word, of course. I think you do know who said it. But this is what effectively has been happening on the African continent. And just to sort of, I did a quick exercise that there's 120 odd Chinese companies on the Fortune 500 list. Most of those are, a vast majority, with one or two exceptions, would be state-owned companies. Of those companies in recent years, roughly about of 120, about three quarters, let's say 70 to 75, are present in Africa at any one time, contracting, investing, whatever it may be. And of those 70, 75 odd companies, you have two financiers by and large, China Exim Bank and China Development Bank, two policy banks, more on that shortly. But ultimately, so think 70, 75 odd companies, two financiers, one shareholder, Beijing. This is very, this is a geopolitical mercantilism in a form that has not been seen for a couple of centuries of how China is engaging in Africa. And when one starts to understand the drivers of that engagement and motivations behind it, you start to look beyond the return on equity, return on investment that many traditional private capital holders will be looking at and trying to find some sort of measurements there. The measurements are far more geoeconomic and geopolitical. So the Belt and Road was nothing new. Belt and Road was a term like all incoming Chinese presidents of the state come up with their own grand theory. And Xi Jinping's was Belt and Road. Well, it was nothing new for Africa because, as I said, we've been experiencing it since October 2000, effectively, when the Chinese, in a strategic fashion, pulled the trigger in terms of deploying capital to Africa, a lot of which that thinking was underpinned by resource security to particular countries. The BRI is nothing new. It just has a new term. For us, it's old news in Africa. And I think often the flurry of interest in recent years around BRI merely, I think, talks to the sort of ignorance of what took place before BRI to Africa on a far more intensive scale. Just in terms of BNI, Xi Jinping has spoken about a $1 trillion deployment of capital. About in the first decade of engagement post 2000, roughly about half of that, give or take, has been deployed. So we're actually only halfway in, I think, in terms of the pledge commitment at least. And I read a stat that if this was this $1 trillion pledge channeled through those two policy banks by and large, if you look at the equivalent, if inflation adjusted, that is 7 times what the US's Marshall Plan post World War II recovery was. 7 times. So it really is quite significant firepower, to say the least. So coming back to my point, and I'll end on this chart if I may, and just more of a graphic story to paint a picture rather than me just describing it. So what has been happening through that causation correlation of a commodity underpinned growth model that is Africa, with the end customer ultimately being China, this is what I'm seeing. This is Eastern Africa. The figures may be out, but not by much, I hope. You have the sort of South Asia, Middle East region, and then you have this, what I'm calling the Africa-Arabia arc economy. And I mention these places because business in this part of the world predominantly is underpinned by a ethnic Indian, sort of often Muslim, Gujarati even diaspora, one of whom is my wife, so inside information here. But you see this integration, these flows of capital, of direction of trade, exports, financial flows, origin of FDI, even human capital flows through the hubs of Dubai, Addis increasingly, Nairobi certainly. And you're having this integration effect. So what I'm saying is the whole Eastern African region effectively is being pulled out of Africa. And as the natural gas comes online, hopefully Rovuma, I think southern Tanzania, northern Mozambique, disruptions aside, 70% of our products go into Asia, predominantly China. So you're seeing this gravitational pull of the market is effectively pulling the whole eastern part of the continent out of Africa. And I say to my friends in Addis, Africa's integrating, yes, but with somewhere else. And this schism, and it's been likened almost to Latin America, Charlie, where you have this this line straight down the middle, where you have the sort of what I call, me being rather facetious here, but the economic crazies on the right, the Argentinas, the Venezuelas, at times the Brazils, and the more reformist pro-business countries on the left, the Colombia, Chile, and the like, etc. This line down the middle of Africa is also very, very increasingly distinct. So conclusion being, Eastern Africa, large swathes of it, is increasingly becoming near Asia, and that's reflecting the GDP growth figures as well, as are those commercial ties. And China has come into this. This is not a new trend, it's historical, but it's been put on fast forward. And China's engagement in Indian Ocean and these countries in particular around infrastructure development has accelerated this process of Eastern Africa being pulled by sort of gravitational forces of state capital to an extent into the realm of Asia. So my concluding thoughts are, I think this debate is now, right now, and you're talking about, Dan was talking about long-term trends. Charlie mentioned it, sort of decade trends of, if countries, it was said in the Economist magazine, if countries stick to their pledges of infrastructure-driven recovery, then clearly, and also China 8% target this year, or maybe slightly above that, we're seeing this very, very strong tailwind potential for commodities, and of course that's very, very good for this part of the world. Secondly is this BRI concept. It's a geopolitical construct. I mean, looking at the deployment of capital and looking at, I think there'll be a slight cooling of the BRI, partly COVID because of lack of travel as well, amongst others, some domestic factors in China. But I think, you're seeing relatively strong growth in China. The private companies tend to benefit a great deal rather than the banks. And this is ultimately unaccountable Chinese taxpayers' money. So the companies can benefit significantly and build beachheads globally using state capital to do so. And I hear anecdotally of many companies, particularly in the infrastructure space, find these projects incredibly profitable, not for the state underpinning it, but certainly for the companies themselves. And effectively what China has done in the last 20 years is externalize subsidies. Subsidies that used to be paid into the domestic economy have now been externalized with the supply chain often that follows. And I think that's a key point to consider. So for me, the key, and this is not just Africa, but I'm seeing it happening in increasingly, not slow, but rapid motion, of marginalization in the absence of vast, effective rollout programs. And for me, we talk about this deglobalization world because of COVID and fragmentation of value chains and supply chains. I think that's not the right word in our case. I think it's more marginalization. That there will be, particularly receipts from travel tourism, you can only imagine, but this notion of natural herd immunity, no one's talking about Sweden anymore. Herd immunity can only come through vaccination programs. And that will ultimately result in more economic certainty, not forgetting that we can only predict the economics if we understand the behavior of the virus or negate its behavior through vaccinations. And the last point is this free trade agenda is probably the most ambitious free trade project since the WTO was formed, I think, considering the pre-existing structural challenges in this part of the world. So, as Leslie knows very well and has seen it himself, Leslie, you've been in China a long while as well, and to see how internal trade in the country boosted competition and drove growth, as it has in India to an extent. But as we're seeing very sizable geographies in Africa, as these tariff and non-tariff barriers start to be alleviated, that will certainly provide a tailwind for growth. And I think that's an impetus to tailwind, but also one which will even further facilitate Chinese trade penetration into this part of the world. Charlie, I went over time, sorry, but just some thoughts, and I hope that's complementing your thinking and certainly teeing up Leslie from New Development Bank. Thank you.
No, that's fast. Stop the sharing on that screen. That would be brilliant. Thank you so much for that. That was really good, really interesting, and big picture. There's a few things I want to draw out. I want to think about this vaccine issue and the idea of a dual north and south. It was something I was tweeting from a Economist intelligence unit map of some countries not expecting to get the virus rolled out before 2022, 2023 even. So I think that is important. But I'd like to turn to Leslie. There is a concern at the moment that China's Belt and Road Initiative has gone a little too far. They lent a little too much without enough thought about getting repaid. And certainly Chinese companies have made profits, those who've built the railways maybe, but the lenders have had to take moratorium on some of the loans. Already we've seen that on the railway line from Ethiopia, from Addis to Djibouti. And I think the Kenyans are about to, or just agreed something similar. The New Development Bank, though, it doesn't feel to me is in quite that situation. It's a different organization. It's not Chinese. Leslie, please come in and tell us to what extent you think your outlook has changed at the New Development Bank. Have you been lending a little less, lending a bit more? What's the story from your side?
Thank you very much, Charlie, for that introduction, and also thanks to RenCap for the invitation, and both of you for setting the scene with those macro pictures that you have painted. Certainly very provocative. Let me say a few things about the New Development Bank first, for those in the audience who might not be familiar with the institution. The institution is still relatively new. We will celebrate 6 years in July, so we're just over 5.5 years old. So the bank was started from scratch in 2015 with $10 billion of capital. That $10 billion came from $2 billion each contributions from the 5 shareholders: Brazil, Russia, India, China, and South Africa. In addition to that $10 billion, each country has committed to also a further $8 billion in what we call callable capital. Callable capital is sort of part of the capital structure of MDBs, and it's a form of a guarantee, if you like. So in addition to the $2 billion cash, which was paid to the bank, there is also this government guarantee, if you like, that we have in place. That means the bank have a subscribed capital of $50 billion. The reason why that's significant, Charles, is that the bank really raises the bulk of its resources in the debt capital markets. So the bank is able, with leverage, to raise money in international capital markets by issuing bonds and raise money very cheaply in the international capital markets. And that's the money that we on-lend to build the infrastructure or to, provide loans to governments to fight COVID and so on. So your own capital, you manage for a return, and you raise money either in the local currency markets of your domestic country or in the international markets. The key to achieving that, the holy grail of being able to do that, is having a high credit rating, right? Once you have a high credit rating, your cost of funding is very low. So multilateral banks, as you know, they were started way back after the Second World War. The World Bank was formed at the Bretton Woods conference at the end of the war. And the aim was to set up an institution globally that can help with the reconstruction of Europe, which was devastated by the Second World War. And after that, the bank's mandate changed and played a significant role in post-conflict reconstruction, if you like. After the Korean War, it played a major role in the reconstruction of South Korea, in Japan, and so on. And this kind of evolved over time. Over the last 25, 30 years, as you both have just sort of pointed out, one of the key features have been the rise of these big emerging markets, China, India, etc. So the reason why New Development Bank was formed was to give greater prominence, a bigger role for emerging markets in this whole multilateral space. So just the one thought that I wanted to leave with you as to why the bank was formed. It's really giving voice and expression to the more important role that these big countries are playing in the global economy. I mean, a lot of people think the bank was just created after this report that Goldman Sachs produced in 2002. But at that stage already, there were predictions that by 2050, the BRICS economies, certainly at the time it was called BRIC, will exceed the GDP of the traditional G7 economies. So that's just a little bit of history. Now let me come to what have we actually done. Since 2015, the bank has now grown its loan book to $25 billion, right? So we have approved loans of $25 billion from a zero start 5 years ago. We only have just over 200 staff here in Shanghai, and we do also have regional offices in Brazil, in Brasilia, Sao Paulo, in Johannesburg, in Moscow, and very soon, in a matter of months, also in Delhi, in India. So the bank's core infrastructure is based here in China. We started last year by issuing debt in the international capital markets. We raised last year our debut dollar bond issuance in June. for $1.5 billion. We followed that up with a subsequent issuance in September with $2 billion. And to give you a sense of the value of the credit rating, we have a AA plus international credit rating, and we're able to raise that $3.5 billion in total at with a coupon of 0.67. In other words, we are paying investors the money that we are receiving from them. We are paying them an interest payment of 0.67%, and we then on-lend those resources at sort of 1.5% or more based on the maturity of the loan to the government. So we make a significant, or we make a modest return, if you like, and we then reinvest the proceeds, the returns, the interest that payments that we get from the government back into the reserves for future lending. So banks like ours don't pay profits to shareholders. We retain those earnings, and that gets recycled into new loans over time. Just two other quick points I want to make about the bank that's very critical. The one is that we did try to innovate on the business model of other multilateral banks, and I'll just mention 3 or 4 very brief ones. Firstly, we tried to be much more agile, much more nimble and fast moving to approve our loans in much shorter spaces of time than what the tradition is for large infrastructure projects. Infrastructure projects, as you know, to build a big, power station or a high-speed rail or an airport takes a lot of time. So we have tried to significantly reduce the amount of time we take to approve those loans, and we've successfully done that, which is why we have 71 loans today and $25 billion of approvals. So the first one is just agility, nimbleness, move fast, etc. The second key feature of our model is everything is green. We are trying as far as possible to embed sustainability. So ESG is not a nice to have. Everything we do is about the green transition. It's about cleaning up our cities, cleaning up the quality of air, quality of water, quality of soil. So everything is about being green and sustainable. A third key area is what I would call local currency financing. We are aiming to, as far as possible, raise money in the domestic markets of our member countries to avoid the foreign exchange mismatch that you typically have when countries borrow from international institutions in dollars, and when their currencies depreciate, the interest payments sort of balloon as a consequence of that. So here in China, as an example, we have already issued 13 billion renminbi of bonds in the local market and then on-lend that money to either state-owned enterprises or to the government. A fourth area I would emphasize is innovation. We have really tried to look for opportunities and embrace fully the scope to do things differently and the scope to adopt new technologies. As you know, Martin made reference to sort of COVID, etc. Because of COVID, many MDBs, many banks and institutions and corporates have gone digital. We have started doing virtual sort of negotiations online. Instead of flying to countries, lawyers would negotiate loan agreements online. All of that was done to fast track the process of getting the capital out of the door to get these infrastructure projects funded. And then finally, what we call local currency, country systems, where we adopt whatever the prevailing country systems are, for example, with respect to procurement or the environment, and we don't impose new standards on countries. I'll give you a simple example. In China, when I arrived here, someone asked me whether I believe that environmental standards in China are high or low. And naturally, I answered low because, the quality of air suggested to me, and I also have an app which calls Air Matters. You can see the quality of air on a daily basis here in Shanghai. And in fact, parents decide not to send their kids to school on the basis of what that app says. My answer was wrong. Why was my answer wrong? Because I could see the pollution. The correct answer is that China does have high environmental standards, but it wasn't always enforced, which means that we must focus on the enforceability of standards rather than imposing new standards. So New Development Bank is very focused on ensuring that there's the implementation of what we call country systems. Then the final point I'd like to make is that the bank really came into its own in 2020. We provided a $10 billion COVID emergency response program. So as I said, we're only 5 years old, and yet we committed a program in size similar to some of our peer, very well-established institutions that have existed for many decades. And the reason for that is we realize this is the crisis that the world is facing now. This is the crisis the BRICS countries are facing. Let's throw all of our resources into, firstly, relief, focusing on the public health emergency, and then 2, economic recovery. So we are still continuing that to this day. We just approved 4 weeks ago, a additional $1 billion loan to India. We will again do another probably $1 billion loan to South Africa. And the aim here is to provide cheaper finance to the government than what they would be able to obtain if they were to raise the debt themselves. If South Africa issues a bond, there is no way that as a sub-investment grade country at BB flat right now, we are AA+, as I mentioned, so we are 8 levels above South Africa in the sort of credit spectrum, right? So we raise money significantly cheaper than the South African government. So we're not just adding to the debt burden. Somebody could say, but these are loans that has to be repaid. What I'm suggesting to you is that it is in South Africa's interest to borrow from an institution like ourselves.
Thank you so much. I totally see that. And I guess there's a few things here that you've said that come out of both of our presentations that we've given. But part of it is the bid for yield. The fact that you could borrow at 0.67%, was it, in dollars is amazing and really helpful. Also, the argument that the South Africans can keep and each government actually borrowing, can keep their interest rate, their burden down the more they borrow from you. I hadn't got that nearly 10 billion out of the 25 that you've lent so far was last year, 40%. So it feels like you're ramping up. Two things struck me, or what I wanted to just draw out a little bit, was when you lend money, it feels like when a Chinese bank, and you're not a Chinese bank, to re-emphasize, I understand that, but when the Chinese banks have lent, it feels like the benefits have come in various ways. If they lend to Kenya, perhaps they can sell more goods to Kenya. A Chinese railway company perhaps builds the railway line. There's lots of benefits. So the bank doesn't necessarily do great out of the deal. They may have to take a moratorium. But there's wider benefits for China Inc. In terms of your lending, have you had any problems? Who have you been lending to specifically? If we take South Africa, I think you've lent $3.3 billion so far.
That is correct.
Who are you lending to? And I would like to draw out that ESG thing. Because when the New Development Bank was set up, I did think that this was a way of getting, to some extent, Chinese financing into commodity producers like Russia, Brazil, South Africa. That there was a benefit on all sides. I'm surprised that the green aspect is a part of what you're talking about. But I think it is the way we're going. And I think a lot of investors now, a lot of our Scandinavian investors cannot invest unless there is an ESG kind of mantle. And I imagine that you'll be getting more bids for your bonds if you're issuing bonds and you're seen as a bank that's supporting that decarbonisation kind of agenda. So I'd just like to get a little bit more on that.
Let me kick off by talking about the ownership of the bank. As you know, it is equal amongst the BRICS countries. These 5 countries came together and each put the same amount of capital, $2 billion as equity in. So the shareholding is reflected in that 20% each. So there is no Chinese character of the bank or Russian character or Indian character. It is completely equal. That is manifested in the governance of the institution, where the board of governors consists of our 5 ministers of finance of the countries. The management here, one from each country. The president happens to be from Brazil at the moment. Myself as CFO, we've got a COO from China. Each one of us, 5 people, sit on the credit investment committee. Each one has 1 vote. No one has a veto. So that's the first major sort of point to make. The second point is that ESG, I would say, is probably the trend of our times. And I would say that one of the key features or takeaways from 2020 and COVID is the acceleration and the recognition that long-term sustainability, environmental sustainability matters. there are a number of surveys now, it's not part of our core conversation today, but a number of surveys that was done over the last 6 months suggest that institutional investors, the people who control the largest pools of institutional capital, most of them, more than 70% of the chief investment officers, report that before 2020 and post 2020, they would argue that that's probably the single biggest variable that has changed, where their investors, their investment committees and their boards are expecting them to allocate more capital to environmental, social, with environmental, social and governance scores, which has to be above a certain threshold. For the new development bank, sustainable development was hard-coded from our very foundation. It's in our articles of agreement or in the constitution, if you like, of the bank. So we have to be green in every respect. So let's come to your question about how the bank's lending has been focused on in South Africa. We started out our activities focusing on lending to the sovereign, meaning to the government, and as well as to state-owned enterprises. And we also started with a lending program to what we call the private sector or non-sovereign operations. With regards to the loan portfolio in South Africa, we have renewable energy linked loans to the Development Bank of Southern Africa, which is the development bank, as you know, that's focused on the region in terms of infrastructure. We have loans to Industrial Development Corporation, which again is a state-owned enterprise that has got a major focus on industrial development as well as also renewable energy. We have a loan, for example, to Transnet to upgrade the port of Durban, which is the single largest port in South Africa. About 2/3 of South Africa's imports and exports, the throughput goes through the port of Durban. We have several loans to Eskom. And these loans to Eskom is not linked to sort of the coal. Eskom's grid is essentially generation power is essentially almost 90% coal, if you like. Our loans are linked to reducing the emissions footprint of Medupi, for example. Medupi is the new power station which has been built. And under the terms and conditions of the loan that Eskom and the government, or Eskom received from the World Bank, they needed to make sure that the emissions levels are capped at a certain point. So we put in place a loan which enables Medupi to acquire the necessary equipment and so on to ensure that the emissions meets the profile of what were the terms set in the IBRD loan, as an example. So all of our loans has a green component. We would not, let me place it emphatically, we would not put money forward to build a coal-fired power station anywhere in South Africa or anywhere else. It is not part of the mandate of the bank. What we will do is work to green or improve the emission footprint of existing coal-fired power stations. There's particular technologies that the Chinese companies have pioneered called supercritical and ultra-supercritical technologies, which is really focused on reducing the emission footprint of the coal-fired power stations. There's hardly no new coal being built here in China as an example.
That's really interesting, and yeah, I'm surprised compared to my expectations a few years ago. I didn't expect that. Yeah. I know we've got people watching online. Anybody who's come in on the Zoom link can also put questions in on the chat, and I should emphasize that on the right-hand side.
I forgot to mention to you earlier on that one critical point, sorry to interrupt you, is that the bank is only BRICS, and a lot of people view the bank as the BRICS Bank. Our name is formerly the New Development Bank, but we will expand and have new members join the bank, and that process has started in 2021. So what I'm suggesting to you is when you have your next conference in a year's time, when you invite me back, it is likely that the bank will have a new set of members that would be part of this institution.
We're already big in Russia, so we'll have you there at June for our May-June conference, which we do every year for the last 25 years, actually, nearly as long as we've been in the markets. I just wanted to come back to what Martin was talking about, because Martin's saying that he reckons the Belt and Road we're halfway through. There's another $500 billion coming, perhaps, in terms of Chinese investments. From what you're saying, Leslie, New Development Bank equally, is less than halfway through. You're going to continue to expand, continue to borrow. There's more lending to come. Martin, do you see what's happened in the last 12, 18 months in terms of China having to renegotiate some of the loans it's done in some countries, like Ethiopia or Kenya? I think Sri Lanka is going to be on the list there as well. And anyway, there's a few others, Zambia. Do you think that's encouraging more Chinese caution for other banks, Chinese Development Bank, for example, or Exim Bank? And to what extent? Well, I guess let's start with Martin first.
Mm-hmm. No, thanks, Charlie. It's certainly a valid question. I think people say that COVID has caused this. COVID hasn't. There were many. COVID's accelerated it, and it hasn't caused, I think, the sovereign blowouts that you mentioned. There were quite a number of sporadic country sovereign cases of ongoing renegotiations with Beijing because of payment arrears. That number has clearly increased. I think the latest count is something like 12 or 13, is it now? Countries have done bilateral deals in recent months to defer payments to China. Again, this is sovereign wealth. It behaves very differently to private capital, my observations. I think for me, the real change started taking place around 2013, 14, where you started to see restrictions on flows or travel restrictions under Xi Jinping. State enterprises had a lot more stricter sort of regulations put in place. And I think as also we're seeing look at it this way, I mentioned earlier, the commodity play. This was initially underpinned undoubtedly by a resource security pursuit by Chinese sovereign capital. By the end of you can think about the situation now, there's a loose parallel. By Q1 2012, I think, latest mid-2012, the stimulus spend post-Atlantic crisis was all gone. And after that, commodity prices dropped quite a bit after sort of early 2012. And that lost a bit of impetus. I think there was a lesser interest in an array of commodities and a more focus on a few from a Chinese perspective, in line with the cooling of the commodity super cycle and China sitting with a lot of domestic debt. As a result of the overspend. Now we have a situation in 2021 where China's stimulus spend has been muted in comparison, not that bazooka spend of 10, 12 years ago. And there's a lot more sanguine approach of how Chinese capital is viewing Africa. So to answer your question directly, it's nothing new in terms of African states not being able to service their debt. For the Chinese, they have managed it before. They kick the can down the road, and there's the policy banks, not the companies, take the hit. So I expect more of the same, but in a somewhat more measured approach, somewhat more circumspect, and not the extreme politically driven enthusiasm with massive checks being signed that has taken place previously.
I just wondered what your thoughts were on the issue of when the loans go bad. When some of the loans go bad. We saw the port in Sri Lanka being kind of given a massive 99-year lease or whatever it was to China in compensation for the non-repayment of the debt. In Zambia last year, kept on being on Twitter that the Chinese were going to get hold of their electricity grid. That was what they were going to get in return for Zambia not paying perhaps the debt they owed back to China. I'm not sure personally as to whether that's really the goal. I don't feel that that's what the Chinese are actually wanting. They don't want to be owning great parts of utility infrastructure in the countries they're lending money to for a railway project or a mine or whatever it might be. What's your impression? I just don't, but I'm not 100% sure. What's your impression?
A slight different view. I think there has been a direct strategy, particularly into Europe, of Chinese capital seeking to invest into utility assets. I think it's far more politicized in this part of the world. But let me give you, Charlie, a very provocative thought. And if you're a Zambian citizen who's subjected to everyday blackouts, ZESCO is your stereotypical, you know where this is going. is your stereotypical dysfunctional state enterprise in this part of the world, and you're enduring, I don't know, 6, 7, 8, 9 hours a day of blackouts, who would you rather have running your power utility? The previous management, or perhaps some team from Beijing?
I'm just wondering whether you're really alluding to ESCOM here in South Africa.
No, I'm talking about Zambia, Charlie. But the thing as well is that this could be a privatization by stealth, effectively, and that would certainly provide a long-term tailwind to better provision of public goods and services in this part of the world. Sounds like a good deal.
I've been reading a book about Ottoman debt and how the countries that the Ottoman Empire owed money to ended up demanding the right to run parts of the economy in what was now Turkey. And they did run some parts of that economy more efficiently because they took a monopoly in certain sectors and could take the revenues to service their own debt. It was a form of colonialism, but nonetheless actually provided some benefit, is what this book is arguing. So that's along your lines. I am going to take this into South Africa. Both of you have got immense experience. You're both based there, or sometimes based there, or have been based there, Leslie. What should I be looking for in the next few years? Because I think there's a bid for yield. I think people are going to put some money in. I think this year should be better after we get past this second wave on the virus. I'm hoping so. But I'm not sure how bullish I should be on GDP and so on. And while I might be bullish 1 to 2 years on the debt, 3 to 4 years out, it concerns me. I mean, I don't want to put you in too much on the spot, Leslie, so I will come to you second. I will let Martin put his feet forward first.
Yeah, Charlie, this is it. For me at the moment, and maybe I'm being too short-termist, it's vaccinations. That's what it's about. You need to create some certainty, and I think there's the sense of negativity can only be cured, excuse the pun, through an effective vaccination program. I think for me, on the what South African leadership I think has forgotten is that structural reform is free. It doesn't cost you anything. Maybe it costs you some political capital, but it doesn't cost the country anything. And I think we're going to start to see that, but the frustration is yourself as an observer, myself as being here, is the grindingly slow pace and the mismatch between the rhetoric and the delivery. So I think there's been a question of, sort of 1 step forward, 2 steps back sort of approach in recent years. And it's all about, unfortunately, South Africa is an incredibly over-politicized place, has been for a long time. And many other EMs, people just get on with the pursuit of capital. The system has been beaten by, or beaten, wrong word, but significantly influenced in a negative fashion by the politics, I'm afraid, and the interpretation and the amplification of that. So more of the same, certainly no bounce. And I would be somewhat more beyond vaccinations, somewhat more interesting in what policy decisions are being made in Beijing around sort of stimulus spend and elsewhere to provide external tailwinds rather than 2021 relying on potentially internal ones, that we call loosely structural reform.
Yeah, we have Arthur Krober from GaveCal speaking at our conference in a day or two to try and get to that issue of what the Chinese are going to do this year and so on. Leslie, I don't want to put you in a difficult position. I'm just curious about what would you like to say to that question of where we're going?
Sure. I mean, I would start out by saying that in looking at the South African economy at the current juncture, it's very important to take medium, long-term lenses. If we look at the short term, Martin has already summarized it accurately, that there is no way we can proceed from this current sort of impasse we're in, unless we get the economy to grow, and therefore vaccines has to be right on top of the agenda. We've got to be able to, in a comprehensive manner, deal with COVID-19, right? Let's start there. But I think there are very important structural barriers, structural obstacles to the South African economy right now. There are a number, they're all well known, we don't have to dwell on them here, but it has to start with electricity as a constraint, as a blockage on economic growth, right? So a short, medium, and very clear long-term plan to implement the necessary reforms to break up Eskom, as has already been decided by government a couple of years ago. And in fact, as we spoke before we started here, way back when I was in public enterprises in the late 90s, we put together a blueprint then, a restructuring plan for Eskom, which involved actually breaking up the vertically integrated monopoly, as Eskom is right now, into 3 distinct units, Eskom Generation, Eskom Transmission, and Eskom Distribution, with in fact a plan to potentially list the transmission company as it's like National Grid, for example, in the UK, and a model to get metros involved in the distribution. So a very clear plan was articulated already 2 decades ago. There hasn't been political will to implement that plan, and it has led to what we have now, where electricity is one of the biggest constraints on economic growth. There are several others which has got to do with rebuilding institutions. Over the last 10 years, as you know, we have experienced a period of an erosion of the institutional integrity of many of our, whether it be regulatory bodies, whether it be state-owned enterprises. We've got to improve the governance with urgency and put capable people onto the boards of these enterprises, CEOs that are capable to run those enterprises. It's got to start with state capacity. In the end, from what I've learned, having been here for almost 6 years now, and having looked at well-run state-owned enterprises in the various BRICS countries, you've got to have skilled, competent personnel. You know, it's one of the, to deal with state-owned enterprises where you are speaking to a CEO or CFO, who's a PhD or a CFA, from Fudan or Beijing or Tsinghua University, or in Mumbai or wherever I go. It is night and day dealing with someone who is clearly not equal to the task. So just building that human capacity is a very, very critical part of the South African growth story. But I think there's no need for new plans, Charlie. It's very important to emphasize that South Africa has well-developed, well-articulated plans as to how to get the economy to be kickstarted. It's about implementation of those plans and the political will to actually drive through those changes and also take the hard decisions. And sometimes the political will has been lacking in that regard.
I'm struck by the fact that sometimes you need to have 5 years of very poor growth before a government finally feels it actually has to do something.
Yeah, the downside of the 5 years, I mean, as you know, it will take, because we're already now 2 notches below investment grade, even if we were just 1 notch below. If you take historical comparisons of other emerging markets, it will take 5 years, exactly as you've just said, 5 years minimum to restore the investment grade status. And that is such a critical metric for our medium-term, long-term growth prospects to attract back in. I mean, last year, north of $150 billion of flows, capital flows, moved out of emerging markets. I don't know what precisely the number is for South Africa after we moved sub-investment grade. You know these numbers better than me, but in order for us to get back that coveted investment grade status, we've got to implement these structural reforms, bring our budget deficit numbers back to the metrics where they were, and so on.
I just on the vaccines, thank you so much for that again. On the vaccines issue, I just read the front page of the Financial Times this morning saying that the Moderna vaccine is going to be redone. There are going to be new trials because it doesn't really work on the new South African variant. And maybe South Africa's dodged a bullet not buying a load of vaccines which won't work. But I think Pfizer and others are saying that it works better. I've been a little surprised now at how slow it's taking for the vaccines to be rolled out in SA. Our morning meeting this morning, yesterday was about financing for this in South Africa is still not 100% transparent. I'm just wondering if the new development bank's going to play a role. And it also comes back to your point, Martin, about a two-speed world where you've got rich, older countries, which, given their age, probably need the vaccines a little, or certainly for a higher proportion of the population. But sitting there vaccinated and comfortable in 6 months' time, assuming there's not too much mutation. And then the South, where it's going to take years. And I just was wondering what your thoughts were on these issues.
I serve very briefly, Charlie. I serve on a sort of forum of all the chief financial officers of the multilateral banks. This issue is front and center of all of the MDBs right now. I mean, we're really kind of looking at this as 10 years from now, when we look back at this crisis, we want to be able to know that the multilateral banks, because this is why we were set up, we are literally by design, our mandate is to deal with problems that are transnational in character, that sort of crosses, that you cannot solve in one country alone. So a pandemic being one of the critical ones, climate change and other things and so on. So the provision of fair, equitable, affordable access to vaccines is at the center of what development banks are talking about today. As you say, it's a little bit sort of complex right now, but there is an active live dialogue, and I think there will be very concrete initiatives that will be announced. I'm giving an example. The World Bank made available something like $12 billion to countries already at very, very reasonable interest rates to acquire vaccines. At numbers likely going to be increased, and many other of the multilateral banks, including ourselves, are likely to step forward. But I think the current situation cries for leadership. You cannot solve this pandemic in one country alone. You can only solve it through coordinated, collective, and multilateral action, right? This is a collective problem, which even if it's controlled in one country, it is not solved unless you solve it in every other country. So I think over the next few months, I suspect there is going to be, whether it's G20 or some international endeavor, to ensure that we pass this impasse right now, where some countries are nowhere, not even in the zone, because they don't have the financial resources to access the vaccine, they don't have the ability to manufacture it, and there are other countries that are front of the queue. So in short, there are initiatives underway amongst the MDBs to step forward and play a stronger leadership role, as was done, may I remind you, in 2008. 2008, the world was in a very deep crisis. The banking system almost collapsed completely, as you know. It was the G20 that stepped forward. That's what really propelled the G20 into the international consciousness. In a similar way now, we need that kind of decisive leadership, whether it's from the IMF or the World Bank or other multilateral banks. We need a body to step forward to ensure that there's order in this regard, and that there is fair and equitable access in the nearest possible term.
Very encouraging. Martin.
Leslie's spot on, but let me add to it as well. This is less a financing problem, I would argue, as it is a functionality problem domestically. And this, in South Africa's case, I mean, I think this will be solved in the coming weeks through court action, which will take procurement and distribution away from the monopoly of the state. I think we'll start to see, in the context of South Africa, we have such big corporates, especially in the mining sector, which organization would be better suited to roll out vaccinations? A big listed mining company or the local municipal government in that location? I think the answer is fairly obvious. So we'll start to see that this frustration and delays. I think there's currently, the last count I heard, Charlie, you know better than me possibly, was 51 countries that are currently rolling out vaccinations. I heard that number as of a few days ago. Perhaps it's gone up. We have yet to start. We hear in South Africa, we hear numbers. We haven't exact timetable, and this is causing a feeling of angst domestically for obvious reasons. Particularly when you mention there's these new virulent strains, which none of us understand. So I think the courts will decide how this plays out, and that's probably a good thing.
Yes, it's certainly I found it disappointing. I was hopeful that Africa as a young continent was going to get through this fairly lightly by global standards. But the trouble is that's fine when the virus only hits, say, 20% of the population. It's not fine, but it gets an awful lot worse when it seems like it's expanding to a much higher proportion of the population. And we've seen the Zimbabwean foreign minister die last Wednesday, and two ministers in Malawi, minister in Eswatini yesterday, I think. And of course, South Africa's lost a minister as well, just in the last few days. So it really is sweeping through Southern Africa, and it's not just a South African issue about the vaccine. We will see how it plays out, but I think it's certainly slowing down the recovery. Would be the most benign way to put it. Right. There was a couple of other issues. Commodity super cycle that you're talking to, Martin. It is an issue of to what extent have mining companies invested enough in spare capacity globally, or oil companies enough, maybe less so on oil. It feels to me that there is this available supply via shale. So maybe there's a difference in the commodity story between oil and the mining companies. And is your sense that there isn't a huge supply available in the mining space to be able to meet global growth? And there is this issue about a global reflation trade maybe getting out of control. Maybe the Fed's been too generous, the ECB's been too generous, and there's so much money flying around. The Bitcoin's at 40,000 or higher recently. So is there an issue that we're going to see commodity price inflation sustained? Is that where the argument's coming from?
Look, some very superficial comments from myself. I mean, during the election campaign, the Democrats and Biden's talking about a $2 trillion sort of focus on new energy, new economy, and that's Leslie's. That's the best thing ever. Imagine the US. I mean, you're talking about sort of the Chinese really have and rightfully so, talking about sort of implementing or actively pursuing green technologies and implementing back home because the situation was so bad it had to change. The whole EV revolution in China, 1.2 million odd EV vehicles sold. Leslie, do you drive an electric car in Shanghai? Putting you on the spot here.
I don't drive in Shanghai. But if I was driving, for sure, it would be an electric vehicle. As you know, I mean, some of the biggest companies I saw last week at a UBS conference, the CEO of NEOM, one of the biggest EV electric vehicle companies. Many people have never heard of this company, $96 billion market capitalization. These are some of the biggest giants. They're bigger than General Motors, and people have never heard of them, but they're Chinese companies just doing electric vehicles.
So I think coming back to a point of exactly that, it's the US pivot or dramatic change, U-turn on energy policy could be dramatic. I think it will be dramatic. So that's the first thing. That will have all sort of implications. I'm very keen to see how the US plays out with policy on shale plays out, because that'll have dramatic implications for West Africa. Oil price, predicting the oil price is a mug's game. We know that, but there's no commodity more impacted by geopolitics than oil. And I think US energy policy and what Democrats say and do is absolutely crucial going forward. On the commodity side, as Leslie said, binding constraints, think power, infrastructure issues as part of the world. So we won't have those tailwinds like, for example, in Australia would, but they're having some political issues with the Chinese. But we haven't got those tailwinds there. But I don't know. I'm not a commodity analyst, but just saying that the ingredients are there. The Chinese are, and again, a lot of growth in China's a different economy to what it was in 2008. The economy has doubled in size, more, maybe 1.5 times the size of what it was back in 2008, 2009. A lot more private sector driven growth, private capital rather than just state capital. But the impetus has been nowhere near the bazooka stimulus what it was in 2008. So we're not going to see the same thing. But again, China's double the size. So is it speed, or is it size of the domestic economy? And maybe it's the latter. And that debates, people get too excited about the numbers in China, the growth, albeit 8% is phenomenal this year, which is what's likely to happen. But it's not so much about the speed of growth as it is about the underlying size of the economy. At growing 8%, Beijing hardly needs to stimulate. The demand is so strong.
That's true. That's very true. I'm going to need to wrap up here. There's a few things I just wanted to draw out for anyone who's skipped through to the end of the video. New Development Bank, 200 people, has lent $25 billion, which is an incredible loan per capita basis and a very cheap rates. And I think it is helping governments and will continue to help governments perhaps in the vaccine area. Most short term, will continue to help governments and development in the countries they're looking at, and we're going to see an expansion of the New Development Bank through 2021 as well to new entrants. Martin, thank you so much for drawing out what you said about China, how it's interacting with Africa, and how it's putting that whole eastern part of the continent towards this new orbit. And we're only halfway through, but I thought your points about some of the issues that South Africa needs to address as well were really very helpful. So thank you both so much for your time. I hope to see you again, obviously in person at some point.
Thank you very much.
Have a lovely...
Thanks, Charlie. Thanks, Leslie. Thank you.
Have a better 2021, I hope.
Same to you.
See you soon. Bye-bye. Bye.
Good morning, everyone. I am Johan Pretorius, the mining analyst at Renaissance Capital, and it is my pleasure today to introduce John Johnson.
John is the CEO of CRU in China and an expert on the global metals and mining industry. John is an authority on China, where he lives today, and his views on the global metals and mining industry are sought by executives all over the world. Just a quick reminder to the audience that you can ask questions in the chat box at the bottom of your screens. Your questions would be welcomed, and I'm sure I've got many questions for John as well. Welcome, John. We look forward to hearing your views on China's commodity intensity over the next 5 years. Over to you.
Thanks, Johan. Let me just share my screen with everybody. Okay, just a moment. So, can you see that okay? Is everything fine from a technical perspective?
It's good, John. Maybe just maximize the slide.
Yeah. Oh, okay, sorry. Yeah, so that's it. Great. So sorry about that teething issue. So yeah, thanks, Johan, and a big thanks to RenCap for inviting me to speak today. And thank you all for listening. My name's John Johnson. I'm the country manager in China for CRU, and I've been based here in Beijing since 2004. I'll be speaking to you about how commodity intensive will China be over the next 5 years. I'll go through the presentation, and then, as Johan said, we'll have a chance for some Q&A. And also, I have my China copper analyst, Raylin Wang, on hand for any particular questions on copper at the end also. I think many of you know CRU already. I won't spend too much time on this. You know, we're independent, London-based leading global metals, mining and fertilizer analysis and consulting company. We publish regular reports, price discovery and conduct consulting. We have 11 offices all over the world. In China, we have 35 analysts based in Shanghai and Beijing. If you want to know more, then please do ask me or my colleague, Ayanut Lazar, who is also online, I hope. And he is often in South Africa, COVID permitting. We'll provide more contact details at the end of the presentation. So this presentation is covering a lot of ground, so forgive me for my high-level views. As always, the devil is in the detail, but this detail is available in CRU reports from a bottom-up detailed analytical point of view. Inevitably, I'm standing on the shoulders of my Chinese and global colleagues and showing results at a high level, but this can also be very useful because you can spot clear trends between different commodities. I've also tried to make this relevant to Africa by focusing on those commodities that are more important to Africa, and also considering the implications for African trade and investment. So I have a simple agenda or structure here. First, I'll consider the China macro outlook and look at the 5-year plan and what we expect to come out from that in terms of its impact on commodities going forward. Then I'll look at the resulting commodity forecast that we have over the next 5 years. And I'll end by considering the impact on the world and on Africa. So first, I thought it'd be useful to remind ourselves about the importance of China. As you can see in this chart, this shows China's production and consumption as a proportion of global production and consumption in 2020. A very simple chart, but you know, these are ranked by the largest proportion of global production from the left to the right in the light blue, and they're twinned with consumption in the dark blue. So the difference between the two, I think, is a good proxy for the trade imbalances, with the largest deficits tending to be on the right because they have lower production levels as a proportion of global production. And I think two things are evident from this. Generally, consumption is higher than production on average. Around 30% across these 60 commodities. It accounts for 30% of production, but more than 50% of consumption. which is interesting in itself because China accounts for about 15%, 17% of global population and 18% of GDP. So you can see how commodity intensive China is, or you could argue perhaps that its geological prospectivity is not as good. And also you can see those commodities on the right are more interesting from a trade and investment perspective. And I've shown those commodities that are most important for Africa in terms of their exports to China in the chart on the right. And there are no surprises there. You can see palladium, platinum, cobalt, copper concentrate, gold, etc. And these are all the areas where China has significant deficits, as you can see outlined on the left there. And this also explains why China has a huge interest in Africa, since these countries, or country and continent, are very complementary. So let me start the presentation by looking at the macro. I think we all know that China's earlier control over COVID last year largely explains the difference in the performance between the major economies in 2020. There has been some recent concern over pockets of local places in China, but the numbers are very low. They're considerably lower than in the West. They run to 100 plus. I can confirm that there are new and stronger measures that have been implemented to keep the lid on the most recent outbreaks that have occurred in Hebei province and other provinces. In fact, I can let you know as an anecdote, the whole office here, we had to go for a COVID test last week to enable us to come into the office. I think the chances of a nationwide lockdown are very remote. There are some logistical issues at the moment, particularly in Hebei, where traffic is not allowed to go between provinces, which is impacting on some flow of commodities between provinces, and some downstream industries are struggling to get hold of raw materials or to ship their products out. But nonetheless, we're assuming this will be brought under control. China grew at 6.5% in the fourth quarter, representing what I'd call a normal growth rate versus the pre-COVID levels back in the fourth quarter of 2019. And China was the only major economy to grow in 2020. And this growth is expected to continue in 2021, when the base effect will show up with high growth levels, not actually seen for a decade or so. But I think that can be a bit misleading simply because of the base effect at the beginning of last year. As everyone knows, all vaccines are rolled out in 2021. As they're rolled out, all economies should reopen, and we should have global growth bouncing back. But this really depends upon the efficacy of the vaccines and the speed of production and distribution, and ultimately on the pace of development of herd immunity. We forecast global growth of 5%, and China becomes a less important contributor to the overall growth level, albeit still very significant. There is a vaccine that is being released in China. In fact, as another anecdote, we were asked, everyone in the office was asked last week if they wanted to sign up to go on a list to go for the vaccine. It's not immediate, but everyone's on a list to be vaccinated over the course of the next month or so. So growth is returning. However, for this presentation, what I'm trying to stress, it's the makeup of that growth in China. That's the important thing, since that will determine the commodity intensity of that growth, which will differ by different commodity groups. So in the past, as we know, investment has been the main driver of commodity growth, with investment share, as shown on this chart, being around 40% of GDP. That's the yellow line on this chart, and showing positive growth in all years, as shown by the green component of the stacked bars. However, the investment share of GDP is plateauing, and the green component in the bar is becoming smaller and smaller. I think this explains some of the slowdown that has occurred in the ferrous market and the base metals market since around 2013, which was really quite a watershed year in terms of those trends. And this so-called rebalancing has occurred with consumption, which is the purple part of this bar, taking a bigger share of total growth going forward. However, that changed to some extent in 2020 because we saw investment was the largest component of growth again and helped to drive the ferrous and the base metals demand again. This was a result of the government stimulus and the benefits to construction activity, and this really explains why the ferrous market did so well during 2020 and supported the iron ore price, and we'll be coming to that, back to that in a few charts. So in 2021, we think that private consumption is likely to make up the largest contribution to GDP growth. In fact, the largest in the post-WTO era. And this is shown by the far right bar, where you can see the purple hashed part of the bar being quite a large proportion of that. And this is part of the continued rebalancing, which is occurring under the name dual circulation. And we think this should continue beyond 2021, and its success will determine the pattern of commodity demand going forward. In fact, it raises a paradox of why we have stronger growth in the ferrous complex in 2020 when GDP was relatively low at 2%, but then slows down, we forecast, in 2021 when the GDP is much higher, potentially around 8%. And I think this is a great example of why it is the makeup of the GDP and not the actual total number for GDP that's the important thing in determining which commodities will do well and which won't. So as a bit of fun, this shows for your interest the outturn for commodities in 2020 for global commodity benchmark prices. And generally this was a poor year with more commodities falling than rising. And it's not just Chinese demand obviously determining the outturn, although China did help to support and offset the slowdown in the rest of the world. But you can see how some commodities, particularly precious metals, iron ore, copper, Chinese hot rolled coil, nickel, manganese, did relatively well compared with other commodities in 2020 for some of the reasons I just expressed. And I'll show you the 2021 results in a few moments. So this year is the first year of China's 14th five-year plan. Five-year plans generally feature announcements of a range of targets covering economic, social, and environmental goals. The precise details of the plan have not yet been revealed, but more will come out from the National People's Congress, which takes place in March. But we do know enough about the plan to identify some major themes that we think will impact on commodities going forward, and these are shown here. These are dual circulation, innovation, and green developments. We know that domestic consumption will be a major theme, as well as opening up. We know that technology and innovation will be strengthened to reduce the overseas dependency and improve industrial supply chain. We also know, for example, that China will focus on food security. Also, environmental theme targets are expected to be at the top of the agenda due to the commitment that we all know to peak carbon before 2030 and carbon neutrality by 2060. There have already been several white papers on electric vehicle developments, the steel industry, circular economy, and carbon emission trading, which do indicate the way that China is going. So really over the course of the presentation, as I follow now, I'll be considering how all of these plans impact on China's commodity demand. We expect the government to announce an explicit or implied target of average growth of around 5% over the period 2021 to 2025, which is significantly lower than the 6.5% target set in the 13th five-year plan. This will easily be exceeded in 2021, but will be more challenging from then on as China reverts back to what could be called a managed slowdown. The reasons for that growth slowing include some of the following points. Demographics, obviously the population is aging and we've got a falling workforce. Productivity, this is tending to decline due to the slowdown in the rural-urban migration. There are higher costs due to rising labour costs. Debt levels are rising due to past spending. And we have the external environment is becoming more difficult, as evidenced by the US-China trade war and the so-called decoupling. So this growth will become not only more difficult, it will become different as we go forward, and this will inevitably increase the need for a bigger focus on technology as well. So under dual circulation, as it's called, which is almost rebalancing under a different name, consumption as a share of GDP should increase and investment should reduce. As the consumption share rises, it's forecast to cross the investment share around 2022. Meanwhile, trade as a share of GDP is forecast to remain broadly flat, although the mix may change. Of course, targets don't always get met, but really the analysis of past five-year plans suggests that most high-level targets have been close to being achieved. So over the next 5 years, we expect GDP to grow at an average of around 5% and 4% for industrial production. That's notwithstanding some major black swan event. So the reductions in domestic investment and increase in domestic consumption should reduce commodity intensity, since investment is on average more commodity intensive than consumption. Consumption of services, for example, whether hairdressers or e-commerce, are obviously much less commodity intensive than investing in railways, roads and airports, which will ultimately slow down. So this suggests that consumption is to some extent at the expense of investment, but this is not necessarily the case if the economy continues to grow at a relatively good level. However, I think dual circulation is a bit more subtle than that, since the focus is on domestic demand, and that can be at the expense of trade, and it can also raise domestic commodity demand and also domestic investment in those commodities. Also, it's likely that the future breakdown of investment will change, moving away from traditional infrastructure to so-called new infrastructure and technology. And this will certainly influence commodity demand, as well as raising the share of domestic consumption from products produced in China. Innovation, as I said, extremely important for China to improve productivity generally and overcome its so-called middle income trap. In support of this, it's likely that the future breakdown of investment will change, as I've said, moving away from traditional infrastructure to so-called new infrastructure and technology. New infrastructure projects include 5G networks, UHV projects, EV charging stations, light urban rails, data centers, and so on. Not all of these are large metals consuming industries, as we all know, but they will consume larger quantities of some minor metals, lightweight metals, and battery metals such as lithium, cobalt, and nickel. So even though volumes may not rise as much as in the past, the mix is likely to change. China will also continue the trend towards the production of high value-added products, so the rest of the world will find it more difficult to export high value-added products to China. On the right-hand side, you'll see the supply side cutbacks that we expect are likely to continue to bring supply in line with demand, notably in coal, in steel and aluminium, with a focus on higher value rather than volume, of course. I think this is also relevant to environmental strategy that's being pursued in China. So the impact of China's environmental policies, notably after President Xi's recent announcement of carbon neutrality, are almost too numerous to mention, and they cannot be overestimated. At CRU, we've been doing a lot of work in this area, analysing the implications of the green policies that are being pursued in China and elsewhere. Obviously, the industries most impacted will be those directly producing CO2, the power industry, steel, motor vehicles, or those that are using significant energy, particularly if it's fossil fuel based, whether aluminium or ferroalloys, including those mining fossil fuels. Obviously, coal will be impacted. So we've broken these down into 4 main strategies that China will be pursuing going forward. First, in power, expect an energy transition away from fossil fuels towards renewables such as wind and solar and nuclear, with all the implications that will have for commodity demand. Expect more power reform and national emission trading schemes that will be introduced potentially beginning from February next month, very soon. At CRU, we've done a lot of work here in creating an emission analysis tool to evaluate the costs of the carbon emitted on an asset-by-asset basis, not just in China, but globally. That's the first strategy, looking at power. Second, in industry, expect more focus on efficiency and the need for more high-quality feedstocks relevant to raw materials. Recycling will become much more important since China is lagging the world in this area, and construction materials will also have a strong focus. Expect climate-friendly mobility to be supported, most important in the form of electric vehicles. Expect some new technologies to become more important, such as hydrogen fuel cells. All of these should support economic activity going forward and are likely to have a profound impact on commodity demand. So that's what I'm going to do next. It's a look at the impact of all of these. So this is what you've been waiting for. What's the outlook on a commodity by commodity basis? Here's the outlook that we have for 15 key commodities for this year, 2021, and over the 5-year period. So I've looked at the differences in our demand outlook in our forecast between 2020 and 2021. On average, you can see there's a strong bounce back in China, going from an average of minus 0.3 to 6% growth next year. However, the trends do differ quite significantly, as you can see, and I've roughly divided them into 3 distinct groups that are color-coded from green to amber and red. You can see the chart on the right shows the growth index from 2004 to 2005, and those again are ranked from the highest to the lowest growth levels in 2025. Now, I'm not going to talk about every single commodity, but I will pick out a few for your interest. Precious metals and battery metals are expected to have good growth, and I think this is good for Africa. Precious metals are currently experiencing a strong demand recovery in China. China's the biggest consumer of gold, and the move towards domestic consumption and a rising middle class will favor this. I'm told by our gold analysts that Chinese gold jewelry demand was severely disrupted by COVID this time last year. The lack of foot traffic in shopping malls, postponed weddings and so on actually had a severe dent on gold demand. However, there's been a strong bounce back in the second half of the year, and this has continued and will continue into the Chinese New Year going forward. Silver and platinum have a similar story. And we think this situation should continue with ongoing economic growth, a rising middle class, and WeChat app for gifting gold as an interesting example. So China will get back to its previous 29 gold demand, we think, by 2022. Platinum and palladium are also enjoying strong demand from the auto sector after newest emission standards were delayed in 2020. The former is enjoying growth from commercial vehicles, incidentally, so platinum is enjoying something there. Electric vehicle battery growth is also explains the rise in battery metals demand, and that will continue. We have strong forecasts for 2021. Stainless steel also enjoys a strong demand recovery favoring nickel and chrome. The real laggards in this chart are coal, steel and steel making raw materials, including manganese. And as I suggested, despite the strong growth in GDP in 2021, this will not see the traditional infrastructure growth that we saw in 2020. And by the way, most base metals fall into sort of a mid-range category. So I think it's interesting to divide growth into the 4 5-year plan periods between 2006 and 2025. And for all commodities, you can see there's a clear slowdown throughout the period. But the 14th 5-year plan shows a small pickup compared with the 13th, an average increase of 5.7 versus 3.5. And I think this is possibly because of COVID dragging down growth during the 13th 5-year plan, but there are other factors. The trends during the 14th plan are similar to those identified in the previous chart, with battery metals and precious metals showing a strong performance over the next 5 years. Base metals are relatively okay at 4% average growth, but ferrous is actually declining. So to answer the question really posed by the title of the presentation, how commodity intensive will China be over the next 5 years? This is shown by the chart on the right. This shows that commodity intensity of China per unit of GDP actually started falling in ferrous back in 2013. As I said, that was quite a watershed moment. And it's been flat to a small decline in base metals since that time also. But it's been rising incredibly in battery metals, albeit from a very low base. And precious metals, shows some quite volatile growth over that period, but we are actually forecasting it to increase the growth over the 14th 5-year plan. So in 2020, China was the only growth engine, as you can see from the chart on the left, in almost every one of these 15 commodities except for zinc. They were all showing positive growth. And they fell in all countries ex-China, except for lithium, which showed some positive growth. But going forward, the picture is much more mixed, with ex-China experience consistently higher growth in all commodities, albeit higher in China in 3 of the commodities, lithium, cobalt and stainless. I think this is significant for miners and producers in so much that market growth prospects may be better outside of China in some commodities. Of course, this also depends upon the volumes of growth, which we'll be considering in a few moments. But you can see in metallurgical coal, iron ore, steel, for example, the demand actually falls in China, but it actually increases ex-China, outside of China. So with that in mind, we'll turn to steel and iron ore next, which has really been enjoying something of an unexpected boom over the last year. But how much longer can that last? I'll try and explain this in these few charts here. So the ferrous markets enjoyed a strong year in China in 2020 after a poor first quarter, culminating with iron ore with prices above $165 a ton and profits in iron ore exporting countries' currencies being at record levels, as we know. The main reasons for this are that the growth in Chinese demand has been more than offset it's more than offset the declines in the rest of the world. And also the supply increases around the world have been below expectations. But how much longer can this last? Well, Chinese crude steel demand and hot metal production reached a peak in 2020 with blast furnace output elevated, iron ore inventories were low. So the fundamentals were good. And this was also exacerbated by some speculation. The future really now depends on the future of Chinese steel demand and the associated production and how much the rest of the world can offset any potential slowdown in China. So going forward, we think the 2020 China stimulus will be unwound and there'll be a lower infrastructure spend or as much reduced growth in infrastructure spend and lower real estate growth during the course of 2021 and even potentially lower exports too. The Chinese government has called for cuts in steel production in 2021. We think this is a signal to make sure the steel sector does not overproduce. It will avoid any capacity creep and possibly due to the expectations of a slowdown in demand. We don't think it's to directly reduce iron ore demand, as some cynics would say, since steel demand will remain the same and steel production would rise elsewhere to satisfy that demand. So the iron ore demand would still be unchanged. Nonetheless, we think that there are some factors that supported iron ore in 2020 will unwind in 2021. But at the same time, the supply deficits will take a while to reduce. I think it's just a matter of time before this happens. We're forecasting a gradual reduction in the iron ore price during the course of 2021 from a first quarter average of $165 a ton to close to $100 by the fourth quarter. In fact, we've upgraded that forecast recently because we've got a little bit more optimistic on iron ore. But still, we think the price will fall during the course of the year gradually. In the longer term, there are other policies recently introduced which will become important and potentially change the mix between iron ore and scrap going forward. And I've listed a few here of interest. A recent policy document suggested by 2025, domestic supply of ferrous containing materials should be above 45%, and that includes the combination of iron ore and scrap. By the way, Chinese domestic scrap supply should be above 300 million tons. It's well below that at the moment. And also to develop one or two leading global iron ore projects. So the direct interest in iron ore will account for a minimum of 20% of imports. And this includes the acceleration of projects for iron ore in West Africa, Simandou, for example, and West Australia, and to enhance cooperation in iron ore in other projects in other countries around the world. And also there's a forecast of EAF share to reach 15% minimum and 20% at best by 2025. And it's around 10% at the moment. So clearly that will potential use of more scrap in EAF will eat into iron ore, but it will be potentially quite gradual, and those targets may be difficult to meet, to be frank with you. So that was a little piece on iron ore. I now like to turn to say a few things on copper. As we all know, China consumes about 50% of world copper, so small changes will have a big impact on the global balances. In 2020, real copper demand was impacted very severely by COVID, but there were two supportive factors for copper and copper prices. Apparent demand was supported by the SRB buying of around 600,000 tons of copper, for one, and the fall in scrap imports, which is used in semis, also added to the refined demand. So those are two important factors in 2020 that helped to support copper demand and copper prices in China. In 2021, real demand is boosted by comparisons with a lower base in 2020 and general growth across all consuming sectors. We forecast total metal demand growth of around 5%, but refining demand grows at 3.5% due to increased use of scrap following the new policy introduced since the beginning of 2021. However, in the longer term, demand is forecast to slide in a phased slowdown associated with the maturity of some copper consuming sectors. We have a flattening in the straight grid demand and some substitution and declining intensities of use, but this will be partially offset by new uses in electric vehicles over the medium term and renewables in the much longer term, as we show here in the chart. But both of these do start from a low base. We've taken account of the rise in renewables post-Xi announcement of carbon neutrality. If renewables grow in line with projections to meet the goals of the Paris Climate Change Agreement and China's own targets for 2030 and 2060, there could be more rapid growth in copper here. Solar and wind installations could surprise us on the upside because the copper intensity in renewables is higher than in conventional power because of the use of both low and high voltage cables. So in the medium term, we have demand growth for copper quite modest, between 1% and 2% over the next 5 years, an average of 1.8%. So this shows a relatively, let's say, positive growth story for copper from a China demand perspective. As I said, I've got Ray Lin, my colleague, who can say more about that, perhaps a little bit later in the Q&A session. Moving on, so I'd just like to consider the impact on the world and Africa now. As I suggested previously, Chinese demand has helped to support global fundamentals in 2020, notably in iron ore, but this may no longer be the case going forward. This chart highlights the areas where Chinese demand is expected to contribute the largest proportion to global growth over the next 5 years. These are largely commodities that are the winners from China's 5-year plan and have gained from China's focus on dual circulation, domestic consumption, and China's decarbonization, including battery metals, stainless, and its raw materials, precious metals, and some base metals. The absolute incremental growth is quite large in many of these commodities, which will benefit global mining companies. Note that there are some interesting ones that I've not included here. There are quite positive, such as chrome and uranium, for example. So if you're a mining company or have a project in some of these minerals, these should be considered to have positive market opportunities from a China perspective, providing competing supplies are not expanding too much and that you're cost competitive. So even in some areas where growth is negative, such as in iron ore, the volume of imports remain huge coming into China, and there's a very large dependency ratio, notwithstanding my reference to scrap. China requires a steady supply of raw materials to guarantee domestic production, but it also relies heavily on imported mine resources. This is particularly so for some of these commodities I've shown here: cobalt, PGMs, nickel ore, iron ore, copper concentrate, and bauxite that are shown here. And I think this is good for Africa as well. China is trying to diversify away from too much dependency in some of these areas, or to raise its self-sufficiency and ownership. So overseas investment opportunities in all of these areas from China are good, where Chinese companies are investors or are partnering with overseas companies. Buying assets abroad is one important strategy to ensure the security of supply for these raw materials. So I've mapped some of the major Chinese overseas investments in Africa in copper, iron ore and bauxite here and charted the growth in outward FDI into Africa since 2011. You can see the copper mines marked in yellow, iron ore in blue, and bauxite in green. Some of these are not operating yet, and some of these investments are missing. And there are investments missing, but you get the point. I would expect these investments to continue rising again after the fall in 2020. We therefore expect the purchase of mining assets in Africa to continue, particularly from state-owned companies who want to secure a supply of important raw materials and are being actively encouraged to do so. I realize there could be issues over resource nationalism, ESG, debt dependency, and so on, but we think these will largely be overcome. Okay, almost the final slide now. This is really for fun, and it's perhaps dangerous to read too much into this since it shows the difference in annual averages between 2020 and 2021, and it can hide some interesting trends from one year to the next, and we're continuously reviewing these numbers, but it is interesting. For example, it shows iron ore actually increasing with the year-on-year average, but the trend is downwards in 2021. However, it does show that global prices do recover quite strongly in 2021, on average between 7 and 8%, largely due to the demand recovery ex-China. Precious metals prices do best. Overall, we expect 2021 to be another positive year for precious metals. Silver does best. It has a combination of increasing industrial demand and safe haven status. Gold benefits still from continued uncertainty and low interest rates. The palladium outlook is also quite positive due to support from the automotive sector and new regulations. Platinum does okay, but surpluses are expected to come back in platinum. Battery metals do pretty well. Expecting strong growth in electric vehicle demand in China in 2021 and going forward with new policies that are being announced. In fact, all commodities do very well, having quite positive growth in price in 2021, with the exception of only a few. Over the medium term, the forecast remains mildly positive, with the averages of most of these commodity baskets recovering as the world recovers from COVID. Okay, that was my last chart, but I've tried to summarize a lot of what I said with some in this chart with some key takeaways. It's difficult to do it in 6 bullets, but I'll try and have a go here. The first one: Chinese growth is nearly back to normal, but it's the breakdown in GDP which is changing, and this has significant implications for commodities. Next, the 5-year plan will focus on dual circulation, which is domestic consumption oriented, innovation, and decarbonisation. This will favour some commodity groups over others, and we think battery metals and precious metals will do better than others, and this is probably quite good for Africa. China will be less supportive for global fundamentals going forward, especially in ferrous area. Nonetheless, China remains considerably short of many commodities. So even where commodity growth is slow, its huge dependency and large volumes are encouraging the diversification and sourcing and direct ownership of some of these commodities, and the continuation of investment in mining assets. Again, we think this will favor Africa going forward. As I said, the devil is always in the detail, and we'd be happy to provide the supporting details in CRU reports to anyone who's interested. That's the end of the formal presentation. I think we have my contact details, and Ironut's contact details are shown there. if you want to email or have any follow-up questions, and I'm happy to participate in a Q&A session now if we have the time. Thank you. Over to you, Johan.
John, thank you very much, John, for a very insightful presentation. Thank you very much for a very insightful presentation on China, John. We really value your views. Maybe if I can just start with a question. China typically achieves its targets. Over the last 30 years, China has grown very strongly in line with its targets, and it plans to continue doing so, albeit at a slightly lower growth rate of around 5%. But what would you see as the biggest downside risks to the Chinese economy over the next 5 years, given the latest 5-year plan, perhaps debt levels, etc.? I would appreciate your views.
Good question. Yeah, I mean, I suppose the most prominent one that is discussed is debt accumulation and the impact of that it might have on productivity, the inability to continue investing, or the investment that takes place is very unproductive, leading to a rise in non-performing loans and an even stronger and debt issue. I think that would probably be the most prominent one. I know the rising debt in the industrial sector is discussions of housing sector now, and I think that's the biggest concern of the government of over speculation in housing. So if the brakes came on all those fronts, it could lead to a significant fall in growth. I think that's a little unlikely, but if I think China has the ability to act in a crisis very, very rapidly, and it could perhaps quickly overcome that. But there's like a slow burn factor of the debt levels pulling productivity and the economy down, and we could lead to a long-term period of 3% growth, which is probably not enough to push China into a sort of out of this so-called middle income trap. So we'd go through a decade of very low growth, which wouldn't be sufficient to generate the levels of commodity demand that I think that we'd be talking about.
Right. Thank you very much. Thank you very much, John. Appreciate that. Just one final question from me. I see we've already run out of time.
Sorry, yes.
Iron ore is the one commodity that we've underestimated probably since 2015-16. RenCap has been underestimating where the iron price could go. And we share your views and concerns around the reduction in iron ore intensity in China. But what would you say could be the biggest upside risk to iron ore prices from here, if you had to single out one?
Well, supply side is always a big unknown, and almost by definition, going back in time with Brazil and incidents in Australia, but that they are so difficult to predict. I mean, it could be that China attempt to stimulate and are not successful in raising consumption and have to pursue the old infrastructure approach, which could mean that our negative forecasts don't transpire and we get some more positive growth in 2021 that we'd predicted. That's obviously like an upside risk. We may be too negative on the impact of traditional infrastructure.
Right.
Yeah.
John, thank you very, very much for your time and for your presentation today. We really, really appreciate your views, and I'm sure you can perhaps expect some phone calls from that.
Yep. Happy to receive any feedback whatsoever. Thank you very much. Thanks, everybody. Yeah, thank you.
Hi everyone, I'm Stephen Friedman, the precious metals mining analyst at Renaissance Capital, and it's my pleasure to welcome Benny Uyen, the executive head of market development at Anglo American Platinum. Just a quick reminder that you can ask questions in the comment box next to the broadcast. And with that brief introduction, I would like to hand over the stage to Benny.
Thank you very much, Stephen. Just want to make sure everybody can hear me okay and you can see my slide. I guess that is a yes. So yeah, good morning, good day, everybody. So my name is Benny Uyen, and I'm responsible for market development at Anglo American Platinum. I'm stationed in London. I am from Belgium. For Christmas, we came over to Belgium to see my family for a few days, we thought. But here I am from my little flat in Belgium, while my big flat in London is empty. But it's working quite well. So of course this has to do with COVID. So anyway, a little bit on my background. I'm with Anglo American now exactly 3 years, and I'm also in the mining industry for 3 years. So this was a big career switch for me. Before that, I was over 25 years in the car automotive business worldwide with various companies. Daimler Chrysler, Hyundai, Kia, General Motors in Belgium, Switzerland, Germany, the USA, and China, which was my last job, where I was responsible for the product and propulsion, so powertrain strategy for General Motors in China. So we want to talk here a little bit about the conference team, which is the Trends from the East, and they influence us a lot. But I want to start it off and kick it off a little bit with what we're doing in Anglo American for market development and how that fits into our whole hydrogen strategy and how China plays a role there. So I think I want to give you a little bit an overview, a little bit of broader picture of what Anglo is doing and thinking and how we look at things. And the first slide in my presentations is always the most exciting slide. It will go only downhill from there, if it would only work, and it doesn't. All right, that's the most exciting slide of the day. It's our lawyers who always ask me to put that in. And of course, I will give you now 15 minutes to read it and ask questions about it. I will not. I will quickly pass this, but I have to be very respectful because my wife, who is running around in the flat here, she's actually a lawyer. So I will be in trouble if I tell her that her job is not exciting. So, all right. So what are we going to talk about today? We're going to talk about our approach to PGM market development in Anglo. So you can see a bit the broader picture. I want to share how we look at things, how we approach this very broad and wide subject. Then from the theory, a little bit into practicality, what I can share, some highlights of our activities and projects that we are engaged in and we're doing in Anglo American. And then I want to talk about China, right? So let's start with how Anglo American looks at the approach to market development of PGMs. Very important here is that we talk about PGMs. So it's not only platinum. There is a lot of concentration on platinum, but very specifically, we're a PGM company. There's a lot of other metals that we sell and commercially viably sell and have to keep on selling in the future. So it's not only about platinum, but of course, we have been focused quite a lot on platinum. So basically, we do two things. The slide you can see is divided in two. You see on the left side, I call it what we know, and on the right side is what is unknown, what we don't know yet. So what we know already is the demand for PGMs in certain sectors, and that we develop and we support to the biggest extent possible. So that has to do with platinum jewelry. It has to do with platinum investment, where together with our colleague producers from South Africa, we support these activities and these organizations called the PGI, I think you know them very well, and the WPIC. And then, of course, we're also quite active in hydrogen technologies. It's very well known that hydrogen is predominantly a platinum play. Platinum has a big role to play in the hydrogen economy, and that's why we are very engaged in there. But this is already known technologies, right? This has to be brought to scale so that it can be adopted in the world and be successful and create a cleaner environment and create PGM demand. But in the world of platinum, and I feel very strange as an automotive guy talking to the platinum experts or PGM experts in the world, which are the South Africans. For example, I was flabbergasted when I came on a business trip for the first time in my life to South Africa 3 years ago, and in the hotel room I switched on the TV, and there was the weather forecast and then the platinum price. And I was like, I'd never seen that in my life. So I know this country is very astute with it, but it was only discovered in the 18th century. It's a baby among metals, and there is still a lot that we know that we don't know. We know that there's still a lot that we don't know. So we are going into different fields and looking there really at the frontier of science, what other applications could be there. And there's things like batteries and storage. Can PGMs play a role there? Carbon neutral feedstock, low loss computing, food technology, medtech, and many, many more. So we will talk about that. But so this is a little bit how we divide and conquer the world. So more specifically, in Anglo, what we do is we look at opportunity areas, right? And these are just a few examples that I give, but we have a whole line of opportunity areas that we can potentially see future PGM demand, and then we map that out on the right. You can see from an opportunity area to creating demand. And I'm actually gonna move my box here a little bit because I'm standing in my own slide. There you go. Moving from focus on creating ecosystems, and you move to the right to more business growing, and then towards scaling, which then leads to cost efficiency, which leads to market adoption. And for each opportunity area that we identify, we place the triangle that you see there where it is. So for example, I just put 3 examples out here. There's more, but one is a green hydrogen production and mobility. That is very clear. This is one of the big prizes that can be won for the platinum industry, and we'll talk about that later a little bit. And that is now, I mean, the technology is known, the R&D is kind of there. Now it's really about looking for partnerships, making sure the environment is there, the legal environment, that this technology can thrive and can get to scale, and through that can become cost efficient. Other things are carbon neutral feedstocks. I think there we're still like on the edge in the product technology side, not at scaling yet. And another very important one is that we discovered and we're really actively engaged in is low loss computing. So PGMs can help with the computer chips and the computer processors of tomorrow and the day after tomorrow, 2.0 and 3.0. I would call it. It's still like in the development product technology stage, but we clearly recognize that, and we are going to engage in that further. So for us, opportunity areas are considered bold from volume, worthiness, if I can call it like that, but also a narrative, right? So it is important for us to communicate about it. So what we actually do is we see ourselves a little bit as shapers or conductors of an orchestra. Right, and you have to do 2 things. We have to shape the environment, and also then inside within the environment, shape the business. That's very high level, 40,000 feet, how we look at the business. We'll give an example of that. This is an example of the hydrogen economy, but we deploy 5 of our core, so in Anglo, like we see it, capabilities for every opportunity area. And this is just now an example of the hydrogen economy. And you can see them ranked there from 1 to 5, and then the first 3 are shaping the business, And the other 2, 4, and 5 are shaping the environment of the business, so the business 1, 2, and 3 can thrive. And there you can be in different stages, so discover and assemble new technology, new ventures, from R&D to new business. I think hydrogen has most passed that phase already. There's a few in there, but hydrogen is now sitting, the hydrogen ecosystem as a whole is now sitting in the deploy and leverage category, where you grow capital and you bring it from new business onto sustainable business, right? And there, and I'm going to talk about that in more detail, we work a lot with AP. We work with AP Ventures. We were the cornerstone investor together with the PIC, and we have invested in a whole slew of a whole chain of companies along the value chain in the wider hydrogen ecosystem. But we will come to that. And then thirdly, when things are mature, we enable commercial collaboration. For example, there are some freight corridors that we're talking about in South Africa, in the UK, but also in China and the EU, where with other well-known players, and you see some of them there with their logos on the slide, where we collaborate to create scale and to create commercial success for this technology. Now, all this can only thrive. You have that with every big, meaningful technology that has to become successful in the market, and that has a fundamental impact on society, because hydrogen will have a fundamental impact on society. That can only help if you have a legislative or a government framework designed around it, so that these projects can become successful. And that's what we do. We make sure this happens. We advocate for favorable policy environment. So, for example, with Hydrogen Europe, with International Hydrogen Fuel Cell Association, in China, with FCHEA in the United States, the Hydrogen Council, which is on the CEO level, a global initiative. So there is a lot of things to be done, and it's sometimes like little details. For example, in the UK, at this moment, if you have a fuel cell electric vehicle, if you want to drive, let's say the pandemic is over and you want to go on vacation to France or to Italy with your car as a family, you have to take the ferry. You cannot take the very popular Eurostar train where you can go on at the tunnel entrance with your car, because there is some rule that this is not allowed yet. We are now discussing with them and say this actually makes no sense. There's other countries where you can go in tunnels, etc. This was just forgotten and overlooked. So this is the kind of little things. Or in the United States, you have to make sure that fuel cell vehicles can drive over bridges and tunnels, which is not the case, for example, between New Jersey and New York, although it's possible in California. So things like that, we try to steer and influence the lawmakers, so the business environment or the legal environment for the business to thrive is in place. Good news is that hydrogen is now taking, in these 3 years that I'm now working in Anglo, when I compare that, when I joined, I was a preacher in the desert for hydrogen, and now it's really hot and sexy, I would call it, because everybody's talking about it, right? So there is a lot moving, and there will be a lot going on there, but we keep a very keen eye on it. And then lastly, it's educate and communicate. That people have to know what hydrogen is all about perception and sentiment. So we have some internal communication, which we call on the Pulse. We have the Hydrogen Council. We have conferences like this one where we talk about that. So this is the 5 areas how we look at, or the 5 action axes, how we operate in market development. So more specifically, our approach is programmatic, complementary, thematic. It's also leverage. That's with APV and customer centric. And from left to right, this is what we do. We first, in a very nascent state, we assemble ecosystems. Then we generate businesses where we bring them up to scale, and you have the right partners, et cetera, et cetera. And finally, when you bring them to market, you scale them so that they're competitive, and then you capture market value. And so what we do in the assembled ecosystems part is we have venture-led research. So traditionally, in market development, I would say the here and now, the current known demand is WPIC for investment, is PGI for jewelry. That would be supported, and then we would support R&D that is looking for new technology that uses PGMs, and then the price for our money that we would get later is when this technology comes to market, would be successful, would create PGM demand. We added now something to it. We want to make money with that right from the start, or later, but we will invest money in it right from the start. So we do very early venture building with startup and venture capital. We're very active in that, where we bring together PGM ideas with talent and capital, and we make it a new venture. In a little bit more mature stage, then we leverage it, right? We leverage our capital. We, as from an Anglo point of view, which is a very good thing, and I will talk about that. So there we have AP Ventures, and then once the product is proven, the technology is proven, you make it commercial, and that's where we work with PGI for jewelry. We invest in investment promotion, and we do commercial collaboration with partners where we scale projects, and these programs are then supported by our two foundations, which I talked about before. It's policy advocacy, you see them on the bottom there, and communications, again, shaping the environment of the business and shaping the business itself. So that was the very high look. I was flying 50,000, 40,000 feet on the edge of space there to give you a big overview of how we look in Anglo-American at market development for PGM. So let's go down a little bit, and let's come down to maybe 10,000 feet and have a more detailed look on some examples of our, and then some highlights of our activities and projects, just to give you an impression of what kind, and this is not an exhaustive list, but what kind of projects we are engaged in. So one is called Alloyed. Right? It's a company in Oxford working with metals. So very logically, they were called Oxmet, but they changed their name into Alloyed. And what is it here? And basically, what they're doing is they have the digital capability to test, to invent and test new alloys with PGMs, with other metals, etc., etc. Rather than in the old way, doing this theoretically and then having to make them physically and then doing tests on it and trying them, and then some fail and you change the formula a little bit and you go back again and you do a lot of physical production of prototypes. That's how I would call it, which is of course time consuming and which is of course money consuming. Alloyed, they can skip all this and do this technically. So I want to draw a parallel with my 25 years in automotive. In the old days, when you develop a car, you have to be able to demonstrate certain safety levels. So you have to do crash tests. In the old days, we used to make 150, 200 prototypes. So before a year, 2 years before the car was out, handmade prototypes, which then we would smash against the wall with dummies inside, and then you would measure all kinds of things to make sure that they're safe. That they're commercial and that they're legally okay, because there is very stringent safety requirements for crash tests in the United States, in the EU, Japan, China, etc. Then came the whole supercomputers, and the computer capability became much more stronger, and you could do this digitally. And now a car can be made with maybe instead of 150, 200 prototypes, maybe you only need 20 or 10 at the end to test. So it's very similar. So first you crash them all in the computer, and then you're going to crash them in real, and your results are much, much better. This is very, very much the same. Because what we noticed is that PGM alloys are often composed, or mainly composed, of two metals. So it's the PGM and something else. For example, platinum ruthenium or platinum copper, where you have other sophisticated metals and alloys on the market, have 6, 7, up to 10 metals and more in their alloy. This is just very complex to do, very expensive to do. With this, you can cut it down. So this has a lot of interesting applications. For us, one is, of course, in the jewelry, where you could make the material easier to handle. You can get into more designs, etc. So we can, with platinum, basically attack or try to compete better against white gold, right? Which has certain advantages, but it wants to look as a material, but it wants to look like platinum. So why not go for the real one if you can make cool and sophisticated, new, trendy, sexy, fashionable designs? It's more scratch resistance, etc. But there's a lot of other applications, and I'm not going to talk about that in detail, but just put one big label on it: aerospace. From planes to satellites, rockets, etc. A lot of interest there. So this is just one of the examples where we try to find new applications for PGMs and do it in a better way, in a quicker way, in a more efficient way. And for us as Anglo, also very early on, build companies. Then eventually, when later they become successful, we get part of the value stream. So this sounds big, but many companies have started like this. Elon Musk has been sitting in a little backyard shop and dreaming about battery electric cars many years ago, and look at it now. A lot of computer companies have been found like that. Who knows, we will have another Tesla or another Microsoft or another Apple on our hand. I sometimes joke to my big boss, Mark Cutifani, that be careful, one day I will be so successful with one of these companies, I will just buy Anglo, right? So I'm not sure whether he finds this funny, but this is like an internal joke that we sometimes have. All right, Li-ion batteries, that's one that we announced. We're very proud of that. So what is this all about? In battery electric vehicles, it is lithium-ion batteries that are there. They have certain disadvantages. Best technology available right now, but the disadvantage is their energy density is not big. It means if you want to have a long range, which is what people want, 600 kilometers or more with one charge, or like they have today in their diesel cars, you need to put a lot of battery in there, which takes a lot of space, which is heavy and is expensive, right? That's why a Tesla Model S weighs 2,000 kilos, right? It is very heavy, and it's a very big car, and it costs what it costs. And even the other ones are quite expensive. So the name of the game is energy density. Energy density you can have with lithium air and lithium sulfur batteries. That is very well known. So they're smaller. So for the same range, you can have smaller and lighter batteries, which car developers love. There's always a fight for real estate, like we call it in car development, because you want more space for the passengers, for the luggage, for crash zones, etc., etc. You have more freedom for the designers. Right? Or you can have, with the same amount of battery that you put in a car today, your range will go up from 400 kilometers to 600 or 700 with lithium air and lithium sulfur. This would be the holy grail, except that they have one big disadvantage, is they degrade very fast. So everything that frustrates you with your iPhones, that the battery after 2 years doesn't last very long anymore, with lithium air and lithium sulfur batteries, you will have very quickly. You will have already after 10 times when you fully charged it, they will start to annoy you. So what did we find out now? That if you add PGMs to this, and I will not go into all the details, this can be solved. So I call this, we're developing the battery of tomorrow. And what we found out is that even with this technology, with adding PGMs to the battery of today, which is lithium ion, you can considerably improve the performance in terms of degradation. So that your cell phone, for example, if you would have this technology, when it's mature, would not start annoying you after 2 years, your iPhone, but maybe only after 5 or 6 years, which would be a huge step forward. So that is what this is about, and we're quite proud on it. We did a joint venture with the Canadian PGM group, Platinum Group Metals, the university in Florida, and we found a company now, and we think this is one of these potential companies that could become quite big. Another highlight is is our capital that is leveraged, of course. So if it's a little bit more mature and the technology is kind of still a bit now, we have to start scaling it and bringing it into market. Anglo was the cornerstone investor together with the PIC in 2018. So first it was internal in Anglo. My predecessor, Andrew Hinckley, who you probably know, now leads very successfully AP Ventures, and well, that's the reason that I made the big jump from the car industry 3 years ago in Anglo. In the meantime, we have attracted a lot of more investors. Plastic Omnium, probably a company you had never heard about before, but when you come from the car business like I do, you have heard about before, because they make everything that's plastic on your car, and that's much more than you think, even on the outside. You have your body, like we call it, the steel body or the alloy body, but all your bumpers are plastic, the caps on your mirrors are plastic, etc., etc. They make that, plus they make fuel tanks, and there you see immediately you can make the link why they're interested in anything hydrogen, because hydrogen fuel cell electric vehicles do have tanks, battery electric vehicles do not have tanks, obviously. Then very proud on adding 3 Japanese investors, Sparks, that's kind of undercover for Toyota Corporation, Mitsubishi Corporation, they're not undercover, very clear, and Sumitomo, I think, very well known. And I think Anglo enjoying a very good relationship with all of our peers. We talked a lot about this with Impala, who are interested, so we had conversations about them joining, and you saw the announcement that they now also joined as an investor in AP Ventures, and we're very, very happy about that, because this will push and give more power and push this undertaking forward. We are invested in a lot of companies there. You see a few examples, it's about 10, but they're across the whole hydrogen value chain, right? It goes from compression, which is hired to fuel cells like Plug Power. It goes to LOHC, which is a new technology, liquid organic hydrogen carrier. This is a German company, to electrolyzers like ErgoSub. Sensors who can sense and detect hydrogen, which is Insplorion, and then hydrogen as a feedstock to the chemical industry, which is HP Now and Starfire Energy. So the whole value chain, we are there with that, with the capital, together with all the investors. We're trying to make these companies successful, which will in the end contribute to a successful hydrogen ecosystem. Okay, more here and now. We know that we need a global demand aggregation, because fuel cell electric vehicles, what is the big price for PGM demand, mostly platinum demand, for fuel cells? It's if fuel cell electric vehicles can have some market success. So forget people who say fuel cell, there's nobody who says that, but if somebody would say that everything will become fuel cell electric vehicles, forget it. But as well, forget that everything will become battery electric vehicles. I can guarantee you that unless there is a new breakthrough in battery technology, where you can charge your car in 3 minutes, because that's what customers want, they will have a big part of the market, but it will not be everything. And the rest will be internal combustion engines and fuel cell electric vehicles. And why is that the big price? Just very back on the envelope math. The total car market is about 100, pre-COVID, is about 100 million light duty vehicles. So I'm not saying the trucks, not counted, 100 million around light duty vehicles in the world, with the future loading, the current loadings in a fuel cell electric vehicle is quite high. So for example, a Nexo or a Mirai, they have 50, 60 grams of platinum on board. That's not sustainable for mass commercialization. But the DOE, the Department of Energy in the United States, has set out a future target where they see scientifically and technically how low can you go to have still an optimal performance in terms of PGM usage, and that would be 0.125 grams per kilowatt, right? The more kilowatt, the more PGM you use. So if you have a typical car, 100 kilowatt about, which is not a race car, you're not Lewis Hamilton, but it's also not a car where you just drive 30 or 40 kilometers per hour. That still has a lot of oomph. A typical family car has 100 kilowatt, let's call it roughly 100 kilowatt. So that means 12.5 grams per car. So if you do the back of the envelope calculation, if between 6, 7, 8% of the cars sold worldwide, only 7 or 8% would have fuel cell electric vehicles would have fuel cells with these very low loadings, future loadings that are not the case today, you would have 3 million ounces of platinum in that. So just it shows you it doesn't have to be much to have a big impact. That's why this is very important for the PGM industry. Now, what is the stage of fuel cell electric vehicles here? First of all, they're behind on the maturity map, so a maturity and cost graph that you have with every new technology towards battery electric vehicles, right? So battery electric vehicles are gaining market share right now, and they will start coming down on the cost curve. Will be doing that, I think, between 10 and 15 years. They are behind. And we are in a chicken and egg situation with fuel cell electric vehicles, where the hydrogen refueling station people, the Shells and the Totals and the fuel station people and the BPs say, I'm not going to put expensive hydrogen equipment in, or they make the investment for hydrogen because there's no cars. And if you go to the OEMs, they say, I'm not going to develop more fuel cell electric vehicles because there's not enough refueling stations. That's why it's very clear in my mind, and I think you read that more and more, it's not going to start with passenger vehicles. It will start with trucks and freight. We are transporting more than just people. We're transporting a lot of goods, right? And with the online economy, this is becoming even more. And a big full-size 40-ton truck, long-distance driving with batteries is just not cutting it. The majority of your 40 tons will be battery then that you carry around. So that will be either diesel like it is today, and if it has to be zero emission, it will be fuel cell. All the experts agree on that. And that is where you also will crack the shell of the egg of the refueling stations. Because with passenger cars, you need a very dense map of hydrogen refueling stations everywhere, because people are not rational. People drive around and they say, oh, here's a nice road and here's a nice lake and let's go there and there. And then the light goes on and they need fuel very close. So you need a dense network. In the freight business, it doesn't work like that. They go along big corridors where you can strategically put not too many hydrogen stations to have enough supply. It's very comparable to the diesel situation in the United States. There's no diesel passenger cars to speak of in the United States. When I lived in the US, my neighborhood fuel station didn't sell any diesel. But on the highways, because all the big trucks, the big semis, like the Americans call it, are diesel, you have diesel. And that will be exactly the same what is going to happen with fuel cell electric vehicles. That will crack the shell of the egg of the hydrogen refueling stations. You will start to get scale, and then it can venture out into passenger cars. So what do? We bring together in Anglo different players, the hydrogen fuel station people, the OEMs, Toyota, Hyundai, others in different countries, and the government in different countries, and form these associations because they're talking about what they call hydrogen corridors. Large fleet operators are also in there. So we do that in the United Kingdom. You see it running there from the south to the north. We are talking about that in South Africa, and I feel embarrassed as a non-South African speaking to South Africans to tell you that a big freight corridor is going from Durban to Joburg, Pretoria, and up. I think you know all that. Also in the EU, I'm pretty sure you have heard about the new Green Deal that the EU is pushing forward. It is almost €1 trillion. Just let that sink in your head. I think it's 800 billion euros that they want to invest in. It's post-COVID, build back better, but it's the new Green Deal. And so there's a lot of funding available, and there's a lot of activity there starting to kick off in the EU. China, we will talk about it. There is the hydrogen corridor of the Yangtze River, right? Yangtze River is the east-west river, the portion in Shanghai, which is an industrial heartland of China. And the Chinese government is very strongly promoting hydrogen, but we will come to that. And then in the US, honestly, and I don't want to get into politics, but when it comes to clean energy, they have been hibernating for 4 years. But the sun is coming out, and the bear is waking up and crawling out of his hibernating place. And Mr. Biden has already made public statement. It's very clear in which direction the US is going to go. They're rejoining the Paris Accords, etc. There will be a lot of interest in the United States, and the United States still being a technological and financial powerhouse. I am pretty sure they will become a very strong driving force in the whole hydrogen economy. So we're keeping an eye there as well, and we're putting our foot in the door to see what we can help invest in direct influence to go in this direction. So I think we may see fuel cell trucks and vans on the roads a lot earlier than thought. And as I said, they will be the icebreaker for passenger cars, which will come later. All right. So Anglo, we talk a lot about hydrogen and we speak a lot like I'm doing now, but we also start doing a lot now. So we are putting our money where our mouth is. And you all heard about that. We call it smart power, where we have these giant trucks that you all know quite well, which are actually ideal to be converted into fuel cell electric vehicles, because the basic architecture is already there, right? Because they were diesel electric, the electric motors were driving the cars, and the diesels were just generators and to generate electricity. And we're converting them, basically replacing the diesel generator with a fuel cell unit that produces its electricity, and all the rest basically stays the same. And we're going to make our hydrogen ourselves on site, in this case on Mogalakwena. We're starting with one truck. We're looking, of course, at more. We're looking at more operations. We're also looking at other mines, other countries, etc. Our target is as Anglo, to reduce our greenhouse gases by 30% by 2030, so in 9 years. And this is one of the projects that will help us with that. This might sound small, but electrolyzer, so green hydrogen production, is still quite nascent and quite small. So the majority of hydrogen is still gray, which is a byproduct from steam gas reforming. You all know this, but with our plant at Mogalakwena, we will have about 10% of global electrolyzer addition, or the additional capacity in 2020. This will now take off because of all the big governments and the big economic blocs like the EU, China, the US, jumping on the hydrogen bandwagon. But still, this has quite an impact there as well, and we're very proud of that. This is also showing basically that we really mean it in Anglo to decarbonize our operations, and we want to stay a leader in developing the hydrogen ecosystem. All right. We're communicating and collaborating with industry partners to grow momentum in China for the hydrogen economy. So we signed, for example, just some examples, together with SAE. SAE is a very powerful organization. It's called Society of Automotive Engineers. They are basically the semi-government branch that prepares legislation and everything automotive. So we have a very good relation with them, and we signed a strategic partnership agreement on fuel cell electric vehicles with them. We are promoting platinum catalyst localization in China through some industrial partnerships. You see it there with Guangdong Jiping, which is a company in Guangdong province during the United Nations Hydrogen Industry Conference. And we also are helping to co-shape a blue book on hydrogen vehicles for Sichuan province. So China, of course, being such a big country, even a province is like a major economic heavyweight and very influential. So the big picture that I want to say here is that we are really at the forefront in China. We are recognized also as one of the thought leaders in everything hydrogen and fuel cell in China, because we started this quite early. And also important is building up a regulatory framework for green hydrogen through key organizations. Again, this is in China. We are the founding member. We actually co-founded the organization that listed on top, the IHFCA, the International Hydrogen Fuel Cell Association of China. And with them, every year in September, we organize actually the hydrogen and fuel cell event of China with a huge conference. You see us speak there, that's on stage with 1,600 attendees, with a test drive with all the Chinese vehicle and van and commercial vehicle manufacturers, where we do a roadshow. We go to different cities during a week, and we set up shop in the middle of the city and explain people what fuel cell vehicles are about, what are the advantages, etc., etc. So it's a huge program that we do every year. I always love going there. I lost my heart a little bit in China, living in Shanghai for several years. Last year, unfortunately, I couldn't go due to COVID restrictions, so I hope very soon this will be lifted. I talked already about China Society of Automotive Engineers, very influential in the Chinese environment, where we enjoy very good relationships with, and the China Hydrogen Alliance. All right. This brings me to China, and I call China, or we call China, the engine room, the global engine room, or the engine room of the global hydrogen sector. So why is that? Just going back with our plane again from 9,000 feet up to 40,000 feet. Why does China do that? And it's very clear. It's for three reasons. One is energy independence, right? They don't like to be dependent on an unstable region in the world where all the oil is coming from, the Middle East, etc. There's a lot of trouble. So energy independence for them is really, really important, right? And hydrogen can become one of the factors where they can achieve that, because hydrogen, basically for green hydrogen, you need water, wind, and sun, and all three are abundantly available in the People's Republic of China. A second one is pollution reduction. You have all remember only 4, 5, 6 years ago, the horror stories from China on pollution, where they were very open also about it. I lived there. I lived in Shanghai. Luckily, I can tell you it was okay, but it's still in winter. It was sometimes really, really tough. In Beijing and Harbin and more northern cities, it was really tough. So for the leadership in China, it's very important that there is no social unrest and dissatisfaction with the government. They really want to keep their people happy by providing economic growth, but also while doing that, not destroying the environment that they live in. So that's a very important strategic axis. And a third one, not to be underestimated, is technology leadership. Right, so they see the model that China wants to go on for the country. They want to copy a little bit what Japan did in the 70s and 80s, where they became a very successful export nation. You remember the days when Japan was buying everything, including Hollywood and the Empire State Building, right? These days are gone. Then in the car sector, but also electronics, chemicals, etc., it became Korea, right? With Hyundai, Kia, Samsung, LG. And now China style, all this times 5, they want to, but that is the next phase of their development. Right? They call this Made in China 2025. I will talk about that a little bit, but they see also the hydrogen sector as one of the areas where they could probably leapfrog the West. They know they will not leapfrog Germany or USA with, for example, traditional vehicle technology, right? When it comes to engines, etc. So they are not trying to become the technology leader there. They're followers, but on hydrogen they want. So that is, or they see a possibility. That is how, or the big axis or the big forces that drive this in China. And this is very clearly stated in their 5-year plans. We are in the 13th now. The 14th is going to be announced in a big conference that they do every 5 years, which is from 21 to 25. And as in the previous one, because we already had some pre-reads, clean energy, new energy vehicles, hydrogen economy has a very clear chapter and a lot of pages dedicated. Okay, so there are strong targets and incentives in place, and the capital is following, right? So it's like 3 layers. You have the national strategy, the provinces, don't underestimate the power of the provinces in China, and then you have the capital markets. They have very clearly designed incentive schemes as well, where you can clearly detect what is the intent of the Chinese government. For example, in the vehicle sector, as of 2021, you have to have X% of your total sales have to be NEVs, new energy vehicles, which means a plug-in hybrid that can drive minimum 80 kilometers on pure electric, or a battery electric vehicle, or a fuel cell electric vehicle. But they don't count for the same. It's not the number of vehicles divided by your total sales that they count, it's credits. And a plug-in hybrid gets the lowest credits. A battery electric vehicle gets more than a plug-in hybrid, but the most credits is for the fuel cell electric vehicle. So very clearly the intention here of the Chinese government to push the fuel cell and hydrogen economy and ecosystem. In China, in most countries, if the government speaks, the country acts, but in China, I would say a little bit more. And the hydrogen refueling infrastructure is growing across the country. And, you know, China is like the US, but without a west coast. So all the population is sitting on the coast. And the more you go west, the more sparsely populated it is. Today, hydrogen refueling stations, there's 100. Just over 100, I believe, in operation. In 9 years, they want to have over 1,000. It's a very clear target by the Chinese government. And in the Chinese system, targets are usually met. Let me put it that way. So I think it will probably be overshot. But that is the key to more refueling stations and then more fuel cell vehicles on the road. And we see already a lot of activity, right? You will see all kind of brands here that you have probably never heard of, but they're very, very big in China and will become big in the world, because that is the idea of the Chinese government. And very clearly they understand that it is starting with trucks, and then trucks need less fueling stations, so the fueling stations will be profitable and economically viable. They will bring fueling stations and hydrogen to scale, which then will be the step towards a denser network of hydrogen refueling stations, because the scale is there, the cost is down, which then will be the foundation of a proliferation of fuel cell electric vehicles for passenger cars. So these are all trucks. These are not dreams. You know, these are not prototypes in the sense of just a one-off. This is seriously planned to be mass produced, and you see already 12 there. Daiyun, Shanxi, First Auto, Hongyang, Weichai, Jiangling, Auxing, Dongfeng, very, very big truck manufacturer. So extremely active there in that field. Once it will go there, I think you will see more and more of this. And this is now a showcase of very big brands that you probably have never heard of. But I lived in the middle of that, because some of them were cars that I worked on as well, right? For example, the SAIC cars, and some of them were competitors. So on the top there, you see First Auto, FAW means First Auto Works, the Guangzhou Auto, Dongfeng Auto, so they have SUVs, right? First Auto Works is a bit asleep in their product planning. They should make an SUV. If you ask me, SUV is the trend of the moment. But you see the other ones have fuel cell SUVs. There's vans, very important in China, because many people, when you're in the middle class, you can afford a driver. And these vans are the typical mode of transportation. So when I lived there, we were not allowed to drive from my company, General Motors, because it was seen as too dangerous. But I got such a car with a driver, basically. It's the best autonomous system you can imagine. The autonomous system was called Mr. Gu, and you just told him where you wanted to go, and he would go there. So no sensors, etc. needed. Fantastic. So big market. It's called the SAIC Maxus Unique 7 on the top right. There's a commercial version of it called the FCV80, we see on the bottom left. And then you have the Japanese, don't forget about them. Hyundai, very strongly engaged in fuel cell electric vehicles with the Nexo, which is a very good looking car. Toyota with the Mirai, I have my doubts on the styling there, but there's a new one out which looks a little bit like an Aston Martin, so very, very cool. And the Honda Clarity. These are just a few. I can guarantee you, if you will put this picture on, or somebody or me will put this picture on in 5 or let's say 10 years, you will see many, many more. The biggest car company you have never heard of is SAIC, Shanghai Automotive International Company. It's the joint venture partner of the 2 market leaders in China, which are General Motors and Volkswagen, which each have about 15% market share. So together, that 30% market share. So SAIC Motor produces in a normal year 8 to 8 million cars. Just to have an idea, Mercedes is 2 million, BMW is 2 million. So these guys are 4 times Mercedes or BMW, or double Mercedes and BMW combined. So they're giants, and they bring out their own brands. They're semi-government, of course, and they have set very clear goals in the ceremony that you see pictured there. Over 1,000 R&D operation employees. They will, within now and the next 4 years, add 10 new fuel cell electric vehicles, and they want to produce 10,000 fuel cell cars per year. So you see very clear intention, very clear targets, and as I said, in China, targets, they really have quite a meaning. You have heard a lot about this Made in China 2025, and I just want to spend 1 minute on it. That's quite important. Because what China really wants to do, what the government wants to do, is transform itself from how they, after the change and the opening up, after Chairman Mao passed away, and they started the change and the approach to the West. But they were the cheap labor force for the West, right? Garments would be made there, etc. It was very cheap to make it there. And gradually, they have. I get a battery low warning, so this is concerning me. They want to change this very clearly into a technology leading nation. As I said, like Japan did in the 70s, they also started as cheap labor pool. As Korea did in the 90s, they also started as a cheap labor pool, but are now a leading tech nation. This is very clearly what China wants to do, but because of its size, China will have a much more profound impact on the world than Japan or Korea. Right. So, and for them, hydrogen and clean tech energy is one of the key vectors on which they want to expand. And that's why we see already this list of startups in the hydrogen and fuel cell space in China. And startups means there is the protecting hand of the government over them. So in catalyst and fuel cell systems, you see them in the fuel cell stack, compressors, testing bench, refueling stations, membranes, power connectors, and others. So a lot of activity going on in China. So I think hydrogen is hot right now. All the big economic powers in the world have taken on, and America will take on, I'm convinced about that, hydrogen as one of their core strategic axes on which they can develop clean tech, and they can still have an industrial base and answer to the biggest challenge of mankind. One of the biggest challenges of mankind, long-term challenges, is climate change. So this brings me to the conclusion. So market development for Anglo-American, we want to have this synergy that it's good for us, but it's also good for the industry as a whole. And these are big words, but maybe create a better world. So we want to accelerate the adoption of PGM-enabled hydrogen technologies. We want to support the platinum jewelry and platinum investment demand creation. I talked about that, and we are looking at opportunity areas that are less known, but with varying demand potential. And this concludes my presentation. I'm going to watch 11:45, so I think I went over. I'm very, very sorry.
Thank you very much, Benny. Thank you for that insight into Anglo-American's approach to PGM market development, current endeavors, which are very exciting, and obviously China's role in driving the growth in the hydrogen economy. I think we've maybe got time for 2 questions. So I'll just try and just put out 2 questions. We've got about less than 5 minutes. But the first question, obviously China dominates the world in terms of commodity consumption for most commodities, but PGM consumption per capita has sort of materially lagged developed economies, specifically, economies such as the US. So my question is, do you believe we will continue to see China's PGM consumption per capita, or PGM intensity, increase or move to sort of that of more developed nations? Or are there sort of regulatory or cultural barriers that may stop that normalization in consumption per capita as China sort of rebalances its economy to a more consumer-driven economy? That's the first question. And the second question is, just given your extensive background experience in the automotive sector, what do you believe are the preferred vehicle technologies for OEMs going forward? I suppose from an emissions perspective, one side, but just in terms of from their own, interest in how they would like to develop the future sort of vehicle mobility.
Yeah. Okay. Big questions. I'll try to be brief. So your first question is whether China will go towards PGM usage per capita like the developed world. My short answer is yes. It will definitely go in that direction. It will become more consumer-led. You will think that China is the biggest demand for anything in the world, but their population is so big. So if you do anything per capita, it doesn't become so big in the world anymore. So that's a little bit the conundrum that you're in with China. And just to give you an example, just vehicle usage, right? There will be a lot of PGM usage for vehicles still. Battery electric vehicles will take over only a part of the market. There will be still for a long time internal combustion engine, then fuel cell vehicles will just start. Just to give you a little basic stats. So in the United States, per 1,000 people, you have 900 cars. In the EU, per 1,000 people, you have 650 cars, 660, I believe, and in China, 170. So it just shows the tremendous growth potential that is still there, just in cars. I mean, because the media just show Shanghai and all this stuff, but I can show you places of China where you think you are 100 years, it was filmed 100 years ago, right? So there is still a lot of potential in demand surge. China is very jewelry astute. They like jewelry, etc. So there's a lot still of potential market for us if we come up with the right commercial strategies, with the right designs, maybe better materials, etc., to take a bigger piece from gold jewelry into platinum jewelry. And then I talked about electronics, computers, computing. There will be a lot of demand for that, of course, in China. And don't underestimate med tech and healthcare. So we have a lot of applications, cancer treatment, scanners, sensors, etc., that are using PGMs, and we are investing in that quite a lot. And with the growing middle class in China, people now have access to better healthcare because they have the money and the financial means and the insurances to do that. And there is a huge potential market still waiting. So there is no such thing as China. China is like you have tier 1 China, and that's the flashy Shanghais that you see on TV, but you have tier 2, tier 3, tier 4. And there, these non-tier 1, tier 1 is about the size of the United States, but the non-tier 1 is still 1 billion people. So there is still a huge potential. So that, to answer your question. The second question is, how do OEMs see that? It's very, actually, not simple, but straightforward. OEMs don't believe in a very fast revolution that something is going to take over. So OEMs see internal combustion engines, battery electric vehicles and fuel cell electric vehicles will be part of the portfolio for different applications and for different countries and regions, because the economic power is not the same. It's nice to talk about battery electric vehicles and $80,000 Teslas, but tell that to people in Cambodia who are happy when they can go from a scooter or from a car into a scooter right now with the whole family. And the next step will be to go from a scooter into a car. They want the $8,000 or $9,000 car. And that's going to take a long time before a basic internal combustion engine is going to be replaced. So that's the way they see it. I think internal combustion engines are still going to be around for quite some time. Plug-in hybrid vehicles are ideal from a customer point of view. They will be a bridge, so a bridge technology. But I can tell you from a OEM point of view, they don't like them so much, because basically you have two cars in one. You have the whole internal combustion engine and gearbox and everything, and on top of that you have a big battery and big electric motors and the control system. And the price versus an internal, or the cost versus an internal combustion engine is this, but the customer only wants to pay this more, and this is less margin, right? Which is something nobody likes. Battery electric vehicles, clearly they will have a place, but it will be for the short cars, for the short distance cars, commuting to work, going to the supermarket, bringing your kids to sports activities, etc. For long trips, unless there is a technical revolution, they're not very practical. And that's where they think fuel cell electric vehicles come in. Most of them are working on it. General Motors is working since a long time together with Honda on that. That's public knowledge. Hyundai, Toyota are pushing this, and they basically keep that in their technology portfolio. So you will see internal combustion engine, battery electric vehicles, fuel cell electric vehicles living next to each other, serving different needs in the market. That's how OEMs look at this market.
Thanks very much, Benny. So still a promising future for PGM demand by the sounds of things.
There is.
And with that, I think I'd like to conclude. We are on the hour. Thank you, Benny, once again, and thank you for everyone for joining today's discussion on PGM demand and the Chinese fuel cell growth over the medium to longer term. Thank you, guys, and have a good day.
Have a good day. Thank you. Bye-bye.
It's now my pleasure to welcome Andrew Cosgrove. Andrew is currently a senior analyst at metals and mining at Bloomberg Intelligence. And today, Andrew will share his views on the coal market with a particular focus on the energy transition. And just a reminder to the audience that you can ask some questions using the chat box at the top of your screen. And you can just send us those questions during the presentation. Andrew, welcome. Thank you very much for joining us today. Over to you.
It's my pleasure. Thank you very much for having me. Hopefully, it's been a great information and fun-filled day for everyone here, and I hope to keep the momentum rolling. So with that being said, let's jump right into it. So today, my presentation is going to take us through the thermal coal market. Certainly not everyone's favorite market, but certainly an exciting one, especially more recently. Lots of volatility, and certainly the path forward is one which I think is going to surprise a lot of people, at least over the next few years. So we'll start off talking about the transition, then we'll talk about the China-Australia trade war a little bit, dig into some S&D fundamentals, and then put it all together with a few key takeaways. So we had recently just updated our global thermal seaborne S&D forecast recently. But with that being said, normally we look out a few years, 2 or 3 years. But I think what this presentation kind of forced me to do was take a step back and look a little bit further. And in order to do that, I utilized our Bloomberg New Energy Finance team projections, their new energy outlook. So on this particular slide, if we take a 30,000-foot view, on the left-hand side, you'll see the global power generation mix. And you can see how coal has been losing share since really, I think the peak there in that graph on the left-hand side is 2014. You can also see on the right-hand side, as far as we look forward, the total amount of gross capacity additions through both fossil fuels and renewables. And I don't know if you can see it, but coal is that little black bar on the bottom. It's got a nice little chunk on the 20 to 25 column, which is essentially made up of new coal-fired generation capacity that's still being built in China. I think the last estimates that we looked at were somewhere around 200 gigawatts of new capacity that's still being built there. And the projections as far as China adding new coal-fired capacity is going to cease in 2025. So we're still going to get new coal plants being built. Certainly some smaller and less efficient ones are going to drop out of the mix as far as China is concerned, and whereby increasing plant load factors for the more efficient ones that are closer to the mine mounts and linked up with solar powered stations as well. As far as the generation capacity additions are concerned elsewhere, India also has a number of them, but in Southeast Asia, whether we look at Vietnam, the Philippines, Bangladesh, Pakistan, again, we have lots of additions coming over on that particular side too. So with that being said, while coal is still continuing to lose mix, the coal generation, as far as BNEF is concerned, is not going to peak for another couple years, specifically in 2024. So you can see here on the left-hand side, I don't know if you can see my mouse, but you had the dip in 2020, and then they have a recovery. Similar to our seaborne import demand forecast, they have the global generation peaking in 2024, then kind of plateauing for a couple of years. But I think what's interesting is that both of these graphs here are the same. The geographical makeup is a little bit different. So I think what's important is if we look here on the right-hand side, we can see as far as China, India, and other APAC are concerned, we don't see peak coal generation in China until 2026. As I spoke about before, that's partly driven by the fact that you have these new coal-fired generation capacity additions happening over the next couple of years through 2025. And then as far as India is concerned, I know it's kind of hard to see with the bar graphs, but as far as India is concerned, power generation on the coal front doesn't peak until 2030 or 2031. And then in other APAC, it doesn't peak until 2034 or 2035. So I say this because it sets up the next slide and really, formulates our view on the seaborne market and how we see things developing. An interesting one thing I'll just say too is that the coal generation peak here, despite the fact that you have China, India, and other APAC generation growing out really over the next 10 years for the most part, really through the end of 2020, is juxtaposed against the fact you have falling generation in the developed world. But the important thing to remember is, what is the seaborne import demand makeup of these two regions, we'll call them. So here on the next slide, what I did was I decomposed the generation growth. And so we have China in orange, we have India in blue, other APAC in pink, and then the total of this cohort in kind of this yellow. And you can see that generation from these three regions doesn't peak until 2027. On the opposite side, you have generation growth in the US and Europe. And you can see, as far as the entire rest of the world is concerned, all of the generation losses over the next, call it a couple decades, but we'll just focus on the next decade really here, are going to be made up of US and Europe. Now, interestingly, this plays into why we think seaborne imports probably won't peak until 2026 or 2027, because you have this, this Asian demand still there for the most part and growing over the next, call it 6 to 7 years. Over here in the US and Europe, these are not import demand centers, right? The US is a net exporter of thermal coal and met coal, clearly. I think we might talk about met coal perhaps a little bit in the Q&A. But again, European thermal coal imports have gotten obliterated over the last few years. They've gone from 120 million tons, I think in 2017, if I can remember correctly, or 2018, to last year they totaled 55 million tons. So, they probably will bounce a little bit in 2021, but as far as the European import, thermal coal imports are concerned, I mean, de minimis relative to some of the growth that could potentially materialize either in China, India, and Southeast Asia. The biggest two questions are going to be, what these demand profiles look like in China, India, and then the all-important one is going to be, what do the domestic production outlooks look like in China and India? Because those are really going to be the two main variables that are going to really drive the delta in seaborne import growth, either in India or in China. And we'll dig into that a little bit as we move into our S&D model in just a few minutes. So I think that's a good setup for what we'll hit on in just a few minutes. But with that being said, I wanted to just spend a couple minutes talking about the China and Australia trade war, because it's an interesting topic, clearly, certainly topical, very pertinent to the coal markets. We've already seen a few things happen in the met coal market, which I'll touch on right now, and the implications for thermal coal could be a little bit different. So as far as met coal is concerned, the chart on the left is showing you the share of Australian met coal imports into China versus others, being made up of Mongolia, Russia, Canada, the US predominantly. And then the percentage share. So you can see that Australia supplied upwards of over 50% of China's met coal imports. And then on the right-hand side, we have a really cool graph, which essentially is showing you the floating storage of coking coal on vessels that are, circling the Chinese coast, in Baoshan and up in Shanghai and Qinghangdou. Interestingly, in our original outlook for met coal a few months ago, we had thought that China would ease restrictions on Australian met coal pretty quickly. The forward curve was in somewhat of agreement with us, where you had the second quarter, third quarter, and fourth quarter contracts trading around 150 or 160, and the spot was trading around 100. So that was obviously a clear indication that the market was saying that China was going to blink by the second quarter. given that you had a $50 spread between the spot market in December and January relative to where the 2Q and 3Q curves were trading at. So as I mentioned that, you can see here how the forward curve in met coal has evolved over that same time period. This is just taking a quick look back a week ago and a month ago. So we have orange, which is the curve as of yesterday, green, which was the curve as of a week ago, and blue is the curve as of a month ago. And you can see how we've really upwardly adjusted on the back of what I just showed you before. About a week and a half ago, China started letting in a few of those offshore floating vessels holding met coal predominantly, and that has also prompted spot trades to increase for maybe some other reasons, but nevertheless, you can see that China started to bend because, as we've seen more recently, if you follow steel profitability in China, both mills that are producing rebar and hot rolled coil margins have flipped negative. You have operating losses of upwards of 200 to 300 yuan per ton in rebar, and then upwards of 100 yuan per ton in hot rolled coil. So again, a lot of that is due to the fact that you have high iron ore prices, but the main reason why Chinese steel margins have flipped negative more recently is the upward increase in coke prices, which is clearly being driven by higher seaborne met coal prices. So what does this mean for thermal coal? So I think these three graphs are going to kind of lay out where we, where we're kind of thinking about what will happen. So we think thermal coal is probably going to be a little bit of a different story. We think China, Beijing will have a little bit more time, a little bit more runway to sort things out. And it's certainly not abundantly clear that they're going to ease up on thermal coal imports like they have for met coal imports. And that's because Australia commands a lower percentage of the import share into China as far as thermal coal imports are concerned. So you can recall back to the previous slide, Australia commanded 55% of Chinese met coal imports last year. In thermal coal, here you see on the left-hand side, Australia is only 19%. In the middle graph, you'll see the breakdown of the tonnage of thermal coal imports, Indonesia being the largest supplier, Australia supplying 45 million tons, others at 48, which include Russia, the US predominantly, and then Mongolia a little bit too. And then South Africa here at 0. But I labeled them here because I think they're going to be an important part of the import share in 2021, because as these trade flows shift, this is kind of our thesis. We think trade flows will shift, and you've already started to see it here in the fourth quarter in 2020, where you're starting to see Indonesian flows, more Indonesian coal move to China, away from India, more thermal coal out of Australia, move to India. South Africa, which I mentioned here, I don't have that import share. I left it off here. I probably should have added it, but nevertheless, South Africa sent a very de minimis amount of thermal coal to China in 2020. We think that will probably change this year as China, demands cargoes from other countries to make up for that lost Australian share. It's only 45 million tons. So again, South Africa, if we took 15 million tons from the Indian share, 10 million tons to China, you lopped off another, say, 20 million tons from India, and then domestic production could make up the balance of that. Again, you could easily, I should say, there's an easier case to make as far as supplanting thermal coal from Australia relative to met coal. So we think, thermal coal market watchers might have to wait a little bit longer to see some better visibility as far as that's concerned. Okay, so the final point here, and probably the most important one as far as formulating the outlook for thermal coal, is the S&D backdrop. So we have near-term hope and somewhat long-term despair. But this near-term hope, I think, runs against consensus views to a certain extent, where most people just think thermal coal is dead, and this rally is probably going to fizzle out at some point soon. So here on the left-hand side, we have our thermal coal S&D balance. And on the right-hand side, we have the year-on-year changes in supply and demand. So last year we pegged the thermal coal market at a 50 million ton deficit. That is essentially due to the fact that you had Indonesia violently cutting production in the second and third quarters. I mean, they were producing upwards of 450 million tons annualized in the first quarter, and exports dropped all the way down to, I think, a low of 30 million tons, I think, in the third quarter. So that would annualize somewhere around 350 or 360. So that's 110 million ton delta in a matter of a couple of months. And that essentially is what rebalanced the seaborne market. Russian flows, which we'll get into also, everything declined last year. But nevertheless, this year we see a bounce back and we see a deficit as far as our base case is concerned in 2021, which should be somewhat price supportive. And as we'll get into, to dig a little bit deeper, I mean, we have deficits over the next 2 years, the market rebalancing in 2023. But that could really kind of be flipped on its head a little bit and tightened. We think there's probably more upside as far as the market tightening versus the market loosening, because if Chinese domestic production does not keep pace with demand, as we just talked about before, which is still, slated to increase over the next few years, then imports probably do not reach our base case estimates, which we'll get into. So as far as exports are concerned, we do see a recovery in 2021. We pegged supply falling last year close to 120 million tons, down 114 to be exact. Indonesia, as I mentioned before, had the largest percentage drop. Russia following closely behind, actually the US, but again, as far as the larger suppliers go, Indonesia was certainly the market mover. Australia, everybody, obviously, to the coronavirus pandemic, imports were hit to a certain extent, whether they be in India. China's thermal coal imports are actually up, but everywhere else, Japan, Korea, India, we're down. So as far as that's concerned, on the right-hand side, we have the seaborne thermal coal cost curve. And I put this up here just to kind of give people an idea as to where we're at right now. So we have Newcastle prices, and I think the front month Richards Bay price at around 85. So that essentially puts us right at the top of the cost curve. The market is certainly demanding those tons right now, given the winter weather and how cold it's been across the northern hemisphere. And as far as the marginal cost is concerned, really hasn't changed over the last few years. FX movements, we've had a big move down in the Aussie dollar, but certainly it's rallied violently over the last, since the lows in March, along with other cyclical commodities. So again, you do have some upward currency pressures in some of the key producing currencies right now. But as far as why the market rebalanced, you can see the 2Q to 4Q 20 price range in 2020 averaged between 50 and 65, and that essentially rendered close to half to 60% of the cost curve unprofitable, and that's why we had a rebalancing in the middle of the year. So as far as our import forecast is concerned, as I mentioned before, you had Chinese imports up last year. It was kind of the lone bright spot, in addition to other Asia, which was mainly a function of higher Vietnamese demand, but lower demand in India, Japan, Taiwan, South Korea, Europe, to a large extent. This year, however, again, I think the biggest wild card as far as this year is concerned on the import front would be China. Myself and our analyst in China, Michelle Liang, we think imports will probably drop this year because domestic production will pick up pace. Again, that's a big if. And again, with that being said, the market is still in a deficit. So if there's upside to Chinese import demand, the market's tighter, prices probably march higher than where they're at right now. That's part of our bull case narrative. With that being said, we do see Indian imports also increasing. Japan, we see increases essentially across the board as demand bounces back. Predominantly, you have high gas prices, LNG prices also trading above coal equivalent quotes in most cases. So that's also pulling on coal to a large extent. And I think as far as the LNG S&D is concerned, right now you have low inventories in Europe, cargoes are getting pulled or redirected out of Europe to Asia, to fuel that winter, that pent up winter demand. And that's also pushing up the curve in the summer and putting a premium on winter futures, which is again helping to spur some of this move up that we're seeing in coal prices more recently. So as far as demand goes over the next couple of years, again, we see increases through 2023, with there being probably more upside than downside risks to our forecasts. So as far as drilling down and focusing on China, on the left-hand side is the S&D breakdown, and on the right-hand side we have China's total raw coal capacity, additions, eliminations, so we can get an idea as to how much supply we can expect to come onto the market over the next couple of years. As far as the S&D is concerned, this year obviously the market was in a surplus to finish the year. I think the date is not necessarily out yet, but depending upon where we finish up here, potentially the market finished in a surplus with inventories increasing a little bit. Again, you have Chinese thermal coal prices trading at multi-year highs right now, and that's also part of the reason why we think thermal coal from a seaborne perspective stays elevated, because that arbitrage is so wide. And once they do potentially start pulling on more cargoes, from Indonesia or from Russia or from South Africa, those curves will in tandem be pulled up as well to a certain extent. But again, I think one of the main points on this slide to look at is the mine production line. So again, we're anticipating domestic production to increase, but as you can see, mine supply from thermal coal really hasn't moved above 3.2 billion ton mark in 6 years, call it. So, assuming that they're going to break through that ceiling, I think is maybe a little, I wouldn't say it's conservative. I'd say it's maybe a little bit optimistic. So if they can't break through that ceiling again, I think that's a reason why there's more upside to our import forecast for China relative to incremental downside, where again, from a net import side being 195 to 200 million tons in net imports next year. And again, just something to think about as far as where Chinese mine supply is going. You have eliminations declining in 2021 this year versus last year relative to the year before in 2019, and with additions creeping up. And I think the main thing to think about right here is really China needs to increase utilization at the mine site, right? So you have thermal coal supply at 3.2 billion tons. You have met coal, domestic met coal supply in China running around 450 to 500 million tons. So total, you have about 3.8, clean washed coal production in China versus total raw coal output of, or capacity, I should say, at 5.4 billion tons. So you're really only operating at 75%. Again, I wouldn't say that's a great number. There's room to move up, but again, they really haven't proven that they can do that. And until they do, I think the onus is upon them to prove that, that will come to fruition. So interesting setup. Again, watching Chinese mine production like a hawk, as we normally do. Certainly one of the seeds to higher import forecasts and potentially prices next year. Okay, so as far as India is concerned, I know there's a lot going on here, and hopefully if you're close to the screen and you got your glasses on, you can read. But again, I think what's interesting is, really understanding the S&D in these key markets, which drive which are the incremental drivers of demand and price, is really key to understanding everything. So that's why we spend a lot of time digging into this, making sure we have the right data, making sure we're leaning on the right levers and pulling the right levers to look forward and look around the corner and see what's going to happen. So last year we had coal generation in India down about 4.5% to 5%. So that was on the power side. Industrials, we pegged down 2%. It might have fallen a little bit more. We see demand bouncing back pretty voraciously this year, up close to 10% on the power gen side, 7% for industrials. And that's mainly driven by the fact that you have, cement production bouncing back, sponge iron or DRI, and then others in the fertilizer sector also coming back too. Because India also had a pretty violent drop down in manufacturing output in these sectors during the lockdown months in April and May and June. So just by extension of there not being any lockdowns in 2021, you're going to get growth this year. So, and on top of that, you also have a number of, easing measures that the RBI has, been putting out there, whether it be, lower real lending rates. You have the rural economy bouncing back. So those are other reasons why we see demand across the board increasing as far as India is concerned in 2021. That's to say we have demand increasing as you look out over the next 4 years, really. So we have total demand up 9.7% this year, 4% 22, 3% in 23, and 3% in 24. So again, pretty strong growth as far as coal demand in India is concerned. Again, the main difference maker is going to be what happens with domestic production. Well, what did it do in 2020? I think most people would have thought that domestic production in India, especially coal India, given the underperformance we've seen from them over the last number of years, would have gone down. Coal India production was actually up in 2020, surprisingly. And I think that definitely surprised a lot of people. And I think that sets up coal India for some growth going forward, certainly more than the market's been somewhat accustomed to. And that's kind of what formulates our forecast for relatively flat Indian thermal coal imports looking out over the next couple of years. Again, coal India disappoints, upside for imports, but part of the reason why they were able to successfully increase production last year was due to the fact that they were transporting more coal on rail and less by trucks. I think through December data or November, the fiscal year in April for India, coal loadings on rails were up 20%, and coal loadings on trucks were down 30 or 40%. So again, that just gives you some scope and context as to why coal India production was strong last year. The other thing that's going to help them going forward is the fact that they moved through a lot of overburden in the last year or two. So strip ratios were high. So they will have, some clean running room as far as output is concerned too. They should be more efficient, which should similarly allow them to increase output. Probably in line, I would think, potentially up, there's probably upside to our forecast for coal Indian production as we look out over the next couple of years. But that's pretty much what caps our Indian thermal coal import forecast over the forecast period at around 168, 165 million tons. So a bright spot, Southeast Asia. Despite a lot of the downbeat news last year, we had Southeast Asian demand up. As you can see here in this top left-hand corner, all of the increase, which was 148 in 2019 to 161 in 2020, was mainly driven by Vietnam, which we estimated the last 2 weeks of the year as far as the import data was concerned for Vietnam. So we pegged imports up about 10 million tons. You also had some strength in Pakistan and Bangladesh as well. And, as far as declines were concerned, I think, declining 1 or 2 million tons in the Philippines and Malaysia, were pretty good performances, all things considered, on the demand profiles last year. As far as this year is concerned, we think everything will pretty much bounce back to where it was before. Vietnam, as far as coal capacity additions are concerned, you have a slug of them increasing this year. You have about 4 gigawatts of new capacity being commissioned this year in Vietnam. 1 in Pakistan and another 1.5 in the Philippines. But that's also what drives our forecast for higher imports over the next few years. As you can see, we have imports going from 161 in 2020 up to 197 in 2023. And that's mainly, again, driven by Vietnam, Malaysia, Pakistan. We have Pakistan imports increasing close to 6 million tons, in Bangladesh as well. And then that's, again, mostly driven by the fact that you have new coal-fired power plants coming online. We have 3 different kind of stages, which the Global Coal Plant Tracker database tracks. So you have under construction, which is more or less, capacity that's going to come online. It's under construction, really no inhibitors to that coming online. And then you have permitting capacity and then pre-permitted development capacity. Our forecasts really just assume that under construction capacity is commissioned and none of this permitted or pre-development capacity comes online, but that certainly adds upside to our forecast. And then just to finish it off, as far as the import demand centers are concerned, would be Japan and Korea. So we have thermal coal import demand increasing in Japan next year. That's mainly due to higher power generation and upward pull on coal as LNG prices have skyrocketed, which have made coal equivalent prices cheaper. And then South Korea, same thing. LNG prices are high. The fine dust management policy, which the Korean government had implemented last year, is actually, you're probably going to see fewer coal plants go idle over the winter months, which is going to boost imports on a year-on-year basis in the first quarter, which is probably going to help the full year total. So over the next couple of years, Japan and Korea should contribute positively to seaborne demand. That being said, as you look out past the forecast period in 2023, 2024, 2025, this is probably about as good as it's going to get for these 2 countries as far as thermal coal imports are concerned, because starting in 2024, you have a pretty big amount. In Japan, at least on the left-hand side here, you can see the retirements really pick up in 2024. And the coal-fired capacity additions. These are all under construction plants here in orange, by the way. So Japan does have a pretty good runway as far as that's concerned. But, after 2024, there's nothing but retirements. And that is obviously not a great sign for imports as you look ahead. South Korea, similar setup. You have the transitioning of the coal plants, the gas plants happening at KEPCO. And you can see these are the plants that are essentially going to be decommissioned from coal, switched over to gas. And most of the decommissioning you can see happens in that 2027 to 2028 period and 2 years after. So again, as we get past this 2024, 2025, the retirements really pick up. South Korea does have a few new coal plants coming online. But again, I think that'll be juxtaposed against the fact that the government is really trying to limit thermal coal imports and coal-fired generation capacity. You also have nuclear capacity coming online in Japan and South Korea, more availability there too. So that's also pushing on the coal gen mix as well. So again, over the next 2-3 years, looks like demand is okay. But after that, we see a structural decline. So that wraps up the S&D portion. As far as big picture takeaways are concerned, coal generation forecast implies seaborne import demand will grow out and peak, we think, in 2026, 2027, with the outlook obviously heavily reliant on domestic production in China and India. As far as the China and Australia trade war is concerned, restrictions are likely to ease on met coal as they already have to a certain extent. We think they'll probably ease more. You'll start to see more Chinese participation in the spot markets for coking coal, which is really what's the main incremental price driver, whereas thermal coal probably takes longer to thaw and or may not even thaw at all in 2021 as far as we're concerned. As far as thermal coal prices, again, we think they're set up to stay elevated, average at least near the marginal cost over the next few years, with the possibility of spikes if if we get disappointing domestic production in China and India, which we think are obviously high possibilities, especially in China. So with that being said, that wraps up the presentation, and I think we can go into Q&A if we have a few.
Thank you very much for a great presentation, Andrew. Very much appreciated. Maybe I'll just ask a few questions. Firstly, on the thermal coal supply side, I mean, we cover many of these metals and mining companies that produce thermal coal, and as far as we can see, we cover a couple of big names such as Glencore, for example, one of the biggest coal exporters. And most of the companies, the thermal coal producers that we cover, have no projects in the pipeline. So, do you believe we could enter a scenario, at least over the next 10 to 15 years, where supply could fall even faster than demand, and taking into account your rather constructive view on thermal coal demand in the near term?
Absolutely, and I would definitely echo your sentiment. I think our coverage overlaps as far as the diversified miners is concerned, and Glencore specifically, no plans to increase production. They're obviously taking production offline. BHP, Anglo, Peabody, Yancoal might be a little bit of a different story. I mean, you do have a 10 million ton mine coming online in Australia, the Carmichael mine, which is going to be commissioned next year. So that's probably one of the main, new supply additions as far as Australia is concerned. But outside of that, as far as net new capacity additions, you're right, there really are none. I think the bigger wild card as far as supply is concerned is Indonesia and Russia, which are kind of black boxes, right? I mean, as far as Russia is concerned, I mean, the government has said that they would be happy to see Russian coal exports, above 200 million tons, 220 million tons. They certainly have been investing in the export capacity to do so. And I think the market might call on that growth. So, whether it be SUEK or, Kuzbaz, as far as increasing output there, the market might need that. As far as we're concerned, as far as you're concerned, right? So, and in Indonesia, we had record exports last year in 2019 at 457 or 460 million tons. It's very well possible that we're going to need Indonesia to ramp up production back to those levels as well. If Australia is not going to be there, if growth in the U.S. is not going to be there, as mines are closing. For ESG pressures and purposes. Colombia is another one which I didn't, speak specifically about. But again, if Prodeco situation is not wrapped up this year, which that could be offline, you could see Colombian exports fall another 10 million tons next year. And, again, South Africa, I think we have South Africa more or less flat or maybe growing a little bit. But, like I said, it's all about Russia and Indonesia.
Thank you, Andrew. That makes perfect sense. How does Russian coal production cost and Chinese domestic coal production cost compare to current seaborne thermal coal prices?
I'm sorry, as far as Russia is concerned?
Sorry, the Russian cost of production, is that well below seaborne thermal coal prices? Does it allow for a decent margin for Russian producers?
Yeah, I think, again, somewhat of a black box, but I'm pretty sure that transport costs to the west would be somewhere around 35 to 40, and then mining costs would be anywhere between 10 to 25. So I think they're still earning a pretty decent margin. I think all-in cost delivered to the ports are somewhere around 50, 55. So I think that's part of the reason why you saw Russian exports come off in the middle of the year when you had export prices, fall into that range, right? So I think they were pretty quick to respond to falling prices, which kind of surprised me because in past periods they've kind of produced or kind of moved through that. I think part of the reason why, it was mainly demand driven. I think exports to the east, as far as Russia were concerned, were pretty strong, whereas exports to the west, to Europe, were obviously, decimated. So it was probably more of a demand erosion story versus, them actually willingly wanting to pull back on supply.
Right. Thanks, Andrew. And then what about the longer term price outlook for met coal? So we're looking at $75 per ton for thermal coal. given the steel demand outlook and the steel production outlook, where do you plot the longer term met coal price? Why?
Right. So look, for everyone, thinking the death of met coal is around the corner because we're gonna, be building hydrogen plants to take out met coal. I mean, that's years away, probably a decade plus, if not two. So there's still a pretty strong runway for met coal. I mean, our long run forecast is still anchored somewhere around 150 to 160. We still think you're going to need more supply. It's not abundantly clear that Chinese imports are going to, I think the Chinese imports are probably capped around that 70 million ton mark. But India, certainly there's new blast furnace capacity additions, which we've outlined and chronicled, which are coming online over the next 3 years. And we know the Indian government has some pretty aggressive capacity aspirations as far as the steel side is concerned. We don't think they're going to reach them, but there's a lot of BF capacity still in the pipeline, and that should be a good tailwind for Indian imports. In Southeast Asia, there's a lot of new blast furnace capacity that's still in the pipeline, whether you look at Malaysia or Indonesia or Vietnam. So again, it's another demand center that's still up and coming. Obviously not with the same punch as they provide for thermal coal, but again, you're talking about imports going from 10, 15 million tons to 25 to 30 over, a tail duration 4 or 5 years. So, yeah. And then, met coal supply is not necessarily, BHP is taking a more market-based approach to their supply. Their medium-term outlook going back 6 months implied that they were going to increase output 20 million tons over the 5-year period. They obviously have responded in kind and taken that down, which I think was a sign, which is a positive sign to the market that, hey, we're not going to overproduce and crush prices. We want to keep things around 140, 150 on a long run basis. Anglo certainly has some good growth prospects as far as they're concerned, debottlenecking. But as far as the U.S. is concerned, you still have mines closing. Exports are pressured. Canada, Teck Resources, you're not really going to get any growth out of Teck. You're going to get some flat line around 25, 26, 27 million tons. And then you have a couple other smaller suppliers that are up there in Canada that are not really going to add a lot of new supply. I think the biggest unknown or the biggest risk to prices is going to be the trajectory of Mongolian exports to China, right? Because ultimately, if China buys more from Mongolia, they participate less in the spot market, and that will, again, take its toll on prices. To the extent that India can pick up that slack, I think is still to be determined. But, as far as we are concerned, Mongolia ramping, they had a really weak year in 2020. We think coke and coal exports will bounce back violently in 2021. They've proven they can export more than 42 million, 45 million tons, on a monthly run rate. It's really kind of sustaining that growth is what is probably the biggest risk to, to our, 150, 160 price view.
Thank you, Andrew. And then just a final question from me. Even against the backdrop of this Australia-China trade war, in the very near term, should we still be a little bit more concerned about potential downside risk to met coal prices, or could it present some near-term downside risk to thermal coal now as well? Or do you believe that we've successfully rerouted our coal to markets which are willing to accept it, and there's some support now for thermal coal?
Yeah, it's a good question. I think for met coal, you have CFR met coal prices. I think they traded at 218 yesterday. The spot FOB was up to 150 this morning. I think you'll have a convergence in met coal. You'll have CFR and FOB prices converging. If they converge, that would imply, if they converge right in the middle, that would imply that FOB spot will be up to 181. Now, I would say that's not necessarily long run sustainable, But if they met in the middle, that's where you could see FOB spot prices go up. And I don't think that's really that far out of the question, especially if you see China come back to the spot market, because as far as the trades go in the participation, they make up over 80% of the the spot trades that go into the Platts and the fast markets indices. So if they come back to to a great extent, I think you'll see prices move up further, spot prices move up further. For thermal coal, yeah, I mean, I think it's interesting that Newcastle prices are where they're at without the Chinese participation. Similarly, again, as I mentioned before, I think because you'll have more Chinese buying from Indonesia and more buying from South Africa, that those particular curves will be supported. And again, what happens with, arbitrages in the paper market between Newcastle, Indonesia, and Richards Bay, I'll leave that to the coal traders. But, I think it definitely means, I think that there's more support versus downside for thermal coal as far as the trade war is concerned. I mean, we're really in the thick of the trade war right now, and coal prices, seaborne thermal coal prices are hanging in pretty nicely. And that's before we get this really, good bounce back that we see coming in Japan, Korea, India, Southeast Asia, and possibly China, right? As I mentioned before, there's upside to our forecast. So I think it's as bad as it's going to be for thermal coal in the short term. And as I said, I think there's probably upside.
Right. Andrew, thank you very much. Thanks for that constructive view on coal, and thank you very much for all your insights. I think we'll have to end it there, but hope to speak soon again.
Thank you so much. Take care.
Ladies and gentlemen, thank you very much for joining us for another session of our conference. I'm very pleased to be able to introduce from Gavekal, Head of Research at Gavekal Dragonomics. This is Arthur Kruber. I met him a decade ago in Beijing, and he gave me the best analysis of what was going on in China at the time. And I'm delighted that he's able to join us again today. So I'm going to hand straight over to Arthur. If you have questions, put it in the chat or write to the salesperson and they can put it into the chat, and I will make sure that we ask, because there'll be roughly half an hour of Arthur's presentation, and then it's going to be open to Q&A. Thanks.
Okay, well, thank you very much, Charlie. It's a pleasure to be here, even if only virtually. But I guess this is our life these days. So I'm going to, first of all, put up a presentation here. And so I'm going to talk, I think, for about 30 minutes. And what I've been asked to do is to give an overview of China's macro situation, the relationship with the United States and how that's going to change under the Biden administration, and then some observations on particular sectors of the Chinese economy that are of particular interest to you. So it's quite a lot of territory. I will do my best to get through as much of it as I can in the 30 minutes allotted, but please feel free to ask probing questions to go deeper in anything that you think that I've skated over. The basic observation that I make about the Chinese economy over the past year and looking forward is that we've really had a 180-degree turn in perceptions of China from just a year ago. So it was a year ago last weekend that China put the city of Wuhan under a complete lockdown and drew a sort of a quarantine line around a much larger area of central China that encompassed, I think, about 200 million people. And at that point, COVID-19 was viewed as a Chinese problem. It was a disease that existed there. The people still weren't, clued into the possibility that it might spread outside of China. And there were a lot of people running around saying this was China's Chernobyl moment, because they had, clearly mishandled the epidemic in its early stages in Wuhan, allowed it to get out of control, then had to have this very sort of panicked response to lock things down. And I remember vividly being at a meeting of very high and mighty foreign policy types in New York in early February of last year, in which this phrase, China's Chernobyl, came up. And the idea was that just like the Chernobyl nuclear accident in 1986, this epidemic was going to be the sort of extraordinary accidental event that would expose the fissures and flaws of China's governance system, and potentially cause a real legitimacy crisis for the Chinese Communist Party. And I have to say, with the year's hindsight, exactly the opposite has happened. China alone of major economies got the virus under control, basically returned most aspects of the economy back to full normal, within a matter of months, and the competence of the ruling government was reaffirmed, whereas the United States and Europe and other countries have really struggled to get things under control. And I can testify, I spent most of last year in New York, but I returned to China in late November, spent two months there before coming back to the US. And basically things were operating as normal. There, other than that, the borders were closed. So I dwell on this because I think it's really important to understand the perspective of the Chinese leadership and the Chinese people, which is very strong feeling that they have a system that works, that is very effective, not only at delivering the economic goods, but also at managing public health crises and other things that come up. And so there's a sense of self-confidence in China that is very notable. Now, if we move from that kind of general point down to the economics of it, I think another important observation is that we've now had, over the past 15 years, two major economic crises. globally, the global financial crisis of 2008 and 2009, and now the COVID crisis. In both cases, China's economy recovered more swiftly and more robustly than any other major economy. So they now, again, feel that they're 2 for 2 in dealing effectively with, major difficulties. But the other points that I think are worth noting are that in 2008, as you probably recall, the way China got out of its economic difficulties was just to throw a gigantic monetary and fiscal stimulus into the system. And that was effective at sustaining growth, but it also created a huge increase in national leverage and laid the seeds of financial stresses that they've really been dealing with for the last decade. This time round, they achieved their recovery with a much smaller relative stimulus, both in fiscal and monetary terms, and a much smaller credit impulse. So, and in 2008, 2009, China had the biggest stimulus program of any major economy. This year, they're kind of in the middle of the pack. So they achieved a better result with a much more modest stimulus, both relative to their past and relative to the rest of the world. So again, I think that's a kind of a validation that China has a system that works pretty well. The final point is that China's exports really performed terrifically the past year, and this is another big difference with 2008. If you go back to 2008, 2009, Chinese exports fell basically the same amount as global trade, and then they recovered essentially at the same pace. In this instance, there was a sharp drop in exports basically for a couple months back in January and February when they had to shut things down, then a very rapid comeback and extreme outperformance. So again, I think this reflects the growing maturity of China's export production system and the fact that it now has central positions in electronics, which obviously was a big item this year in the year of Zoom. But also in things like medical equipment. So with this background, let's take a look at where Chinese policymakers want to take China over the next several years. And I have two sets of points here which relate essentially first to cyclical management of the next couple of years, and then to longer term management. And the slogan of the year was so-called dual circulation. This is a somewhat opaque idea, but essentially what it seems to mean is that the Chinese realize that as the result of trade pressure from the United States and other factors, their integration with the global economy and access to global markets is going to be more challenging in the past. So they have to put more efforts into developing domestic sources of demand, and in particular, domestic substitutes for foreign technology that they have traditionally imported. So there's a clear sense that future growth has to be more reliant on management of the domestic economy, and particularly via investments of technology. And then if you look at the longer term objectives, this emphasis on technology, I think, becomes even more evident. So the plan now, the target is to double China's GDP by 2035. That implies average growth of 4.7% over that period. And if you break it down further, it probably means targeting 5 to 6% growth in the next several years, and then a somewhat lower target, probably a 4 to 5% growth in the late 2020s and early 2030s. And how do they plan to get that growth, which is less than China's history, but still very strong growth for an economy of this size? Basically, their model is, we're not going to do a lot of privatizations. We're not going to marketize a lot more than we have done already. We think we have the balance between state and private sector pretty much right. But what we're going to do is we're going to make massive bets on new technology industries like, well, some of them are not so new, like semiconductors. That's kind of an import substitution thing. But there's also renewable energy, electric vehicles, and the battery technology that goes underneath that, artificial intelligence, robotics, etc. And I think the basic model here is stolen from the venture capital playbook. And so the idea is the state is going to mobilize investments in a whole range of technological sectors. And they kind of recognize from the outset that not every single one of these bets is going to pay off. But if enough of them do, it's like a venture capitalist who invests in 20 companies, 15 of them don't do anything, 2 or 3 do decently well, and then 1 or 2 just hit it out of the park and are spectacular, and the 1 or 2 spectacular successes pay for the mediocrity and the failures in the rest of the portfolio. And I think the Chinese government is adopting a similar approach, broad brush, massive investments across a range of technological sectors in the expectation that a few of these bets will pay off and will generate the productivity growth that is needed for the future. So let me just run through a few charts that will illustrate some of these themes. So this is the economic recovery through Q3. For the year as a whole, China grew by about 2.5% versus negative growth in the other major zones. For the coming year, I think they'll have a headline print of on the order of 8%, but that's reflective of base effect. So I think a more realistic way of thinking of it is that by the end of 2021, we expect that the run rate of annualized growth in China, so quarter to quarter annualized growth by the end of this year, should be in the range of 5 to 5.5%, which is kind of where they were headed for before the pandemic came into play. So slower growth than in the past, but still for a $15 trillion economy, that's a pretty impressive number. This makes the point about credit stimulus. So you may recall back in 2008, China's credit growth went from 15% to 40% in 1 year. This year, if you look at bank loans, there was about a 2 percentage point increase in credit growth as a result of the COVID stimulus. And you see that was much smaller than what we saw in most of the other major economies. Now, of course, there's other parts of Chinese credit aside from bank loans, most notably local government bond issuance to finance infrastructure. So that, if you throw that into the mix, you had probably about a 6 or 7 percentage point increase in total credit growth, but that's still a lot slower than in the past. Now, this is translated into a big rise in leverage. So this is total debt to GDP. And if you look at the red line, which covers all credit instruments, you see that total credit to GDP went from basically 250% to 270% during the year. That's a pretty big increase. But it's important to remember that most of this increase came not because there was a credit blowout, but because growth collapsed. This is a ratio between credit and growth. If the denominator, is really low, as it was last year, the ratio is going to rise. So I think we're already in a pattern of stabilization of this ratio. And I think very clearly the regulators are paying attention to this, and they're going to conduct a moderately tight monetary policy this year to try and make sure that we don't have a repeat of the extended leverage blowout that we saw after 2008. The other observation that we can make about the Chinese recovery in relative terms is that it was much more supply side driven than in the rest of the world. So essentially what China focused on was getting factories back to work, getting the production side back to work. And they were very successful at doing this. Basically, by the end of April last year, after about a 2.5 month period of reduced activity, their factories were back at 100% capacity. The consumer side was much slower to pick up, and here you can see these are different indicators of consumer activity, and you can see that China was slower to recover on the consumer side than the US, and in some respects also slower than Europe. And this is because China's stimulus basically took the form of incentives for the property sector and local government investment in infrastructure. It did not take the form of cash injected directly into people's bank accounts, which was the main form of stimulus in the developed world. But although it was slower to recover, you can see the top line, retail sales are now back to pretty much their pre-COVID level. And although China's consumer recovery was slower to emerge, than the US. And it's probably going to have a little bit of a pullback this month and next month because we've had a little bit of an outbreak, and this is going to reduce Chinese New Year travel and probably cut back a little bit on Chinese New Year spending. But broadly speaking, we think that the Chinese consumer recovery is now on very durable footing. So it was slow to come back, but we're now in quite solid territory. So this is just the COVID outlook. Won't spend a lot of time on this, but to suggest that on the left-hand side, we see the cases of COVID in China, which are basically, they aren't there. And that's compared to the hospitalization rates. So not cases in the US, but severe cases. And again, this gets to the point that in China, the view is that they handled this situation very well and other countries didn't. Now, on the right, you'll see that there have been some outbreaks in different provinces in the north. This has led to a couple of cities being locked down. But I want to put this in perspective. So that area in red is the province of Hebei, which is a province of 100 million people. It's in red because one city, well, two cities in that province had outbreaks. The biggest one is in the city of Shijiazhuang, which has 10 million people in the municipality. There are about 300 cases, which is a lot for China because they want to have zero, but it's a lot less than we would see in other countries. And they've just finished testing of Shijiazhuang and two districts in Beijing, total population 17 million people, and that testing campaign yielded 7 positive results. So yes, there's a bit of an outbreak in China, but it is much smaller scale. And again, the playbook of the government is to move very quickly to contain the spread so it doesn't go wider. And so far, that seems to be working. So a couple of comments on the external sector. So if you look, I mentioned that exports have been very strong. You also saw very strong capital inflows through most of last year, starting in the late second quarter. A lot of people moving into China's bond market because it's the only bond market that delivers, positive real returns. A lot of interest in Chinese equities. This has helped push up the currency, but I want to stress that there are two ways of looking at the Chinese currency. One is the US dollar rate, which is in red, and that's, I think, what most people look at, and that's been going up a lot. But if you look at the trade-weighted index, this is the blue line, you can see that went up quite a bit up until November, and then it's basically been flat since then. And that's the result of Chinese government intervention to try and cap the trade-weighted level of the renminbi. So they're managing the exchange rate. They're allowing some appreciation against the dollar, and the dollar is very weak, but they're managing it so as not to lose export competitiveness. Okay, so that's kind of a quick survey of the macro environment. I want to now touch on a few sectors that are of interest to you. Number one is commodities. Then we'll take a look at the technology sector, and then finally luxury. So as always in China, the property sector, the household residential construction, urban residential construction is really one of the core engines of the economy. And that has continued to be the case. And obviously this is also really central for global commodity demand, commodity prices. So it's pretty important to have a view here. So we had a very strong growth in property sales in 2020. I think it's already, we're seeing some signs of moderation, and I think we'll have a year-on-year decline this year, but it will be pretty moderate, so low single-digit negative decline. And I think the way that this will be distributed in terms of construction growth is that we're going to have very strong construction growth through the first half, and this is because we've had strong sales growth, and developers feel like they need to, get more supply into the system. And as I note here, we have seen a bit of a slowdown in mortgage issuance, but this does not appear to be having really much impact on people's ability to buy. So we have a pretty constructive view on both sales and construction for the first half, and then in the second half, as the economy starts to normalize and as the government basically around the edges tightens policy, we should probably see somewhat slower growth. But so, negative numbers doesn't sound great, but I think as we work it through, the translation into commodity prices is that it's going to be a pretty decent year. We're not going to see the kind of rises in commodity prices that we saw last year, but we see them being reasonably firm. So one of the things that's going on, as I note in the second point here, is that the government has started to tighten policy, and one of the ways they tighten policy is that they tell the banks to lend less to property developers. Property developers are, therefore under a little bit of financing pressure. So what they do is they cut prices to accelerate sales. And so what that will ultimately do is, as they're cutting prices, they move their inventory. That constricts their future level of investment, and that's why we think things will slow down in the second half of this year. But at the moment, we've got pretty decent momentum. All of this obviously is going to translate again in the second half of the year to somewhat weaker demand for steel. But I think there are some, and the underlying, iron ore demand. But I think pricing is still going to be okay. And there are a couple of reasons for this. First of all, the government is kind of walking a tightrope here. They don't want leverage to get out of control. They want to contain credit growth, but they also want to meet, their economic growth targets. So they're not going to tighten too much. And if they get the sense that there's some kind of collapse going on in the property sector, they will loosen up, and this will stimulate more activity. And we've seen this many times before. The other thing is that what we expect will happen is that developers will they'll stretch out their development times. And so what this means is that demand for steel will become more stable, right? So instead of seeing a continued increase and then a big collapse, what we're probably going to see is a moderation and then more of an extended plateau. So that means that you're likely to see reasonably consistent demand for steel through much of the year, and as a result, this will feed into pretty decent, firmness in commodity prices. So that's where we see the property sector going. Now, so what I want to stress is that in the short run, we don't really see a huge problem for commodity prices. But if you take a longer term view, and let me take this, there's no question that the long boom in Chinese housing is pretty much in its final stages. So the chart on the left here shows a model that we've constructed of underlying housing demand. And what this shows, and the different lines refer to, one of the variables in the model is what will be the maximum per capita living space for people in urban China. And in most countries, this turns out to be 40 square meters, with very few exceptions. For various reasons, we think that China actually is going to wind up with a larger per capita living space than most countries, probably in the order of 50 square meters. So I think the most relevant line is the one in red. I think that reflects most accurately the underlying demand. And what that shows is that underlying structural demand for housing has basically hit its peak about now. It's going to be on a plateau, and in fact, if you smooth out the numbers, we've really been kind of on a plateau for the last 4 or 5 years, with some pretty high volatility from year to year. And then by the middle of the decade, we should be in a downward slope. And this is just because of demographic trends, the country getting older, urbanization. We now have over 60% of the population living in cities. So the rate at which they have to build new housing to incorporate new urban migrants is less than in the past. So this is not a collapse, but what it does mean is that although China will continue to build a lot of housing every year, the construction sector will be a much smaller contributor to growth. And you're already seeing this. This is what is shown on the right-hand side. And this is the contribution of the real estate and construction sector to nominal GDP growth. And you can see this has gone from 3 percentage points in 2008 to 2012, basically, to about half that today. And we would see that continuing to go down. So this has an implication both for the sustainability of GDP growth. This is why the government has to place a big bet on technology, because the construction driver of the past is not as strong. And I think it creates some caution for the structural commodity outlook going forward. And we can get into some of the details on this, in the Q&A. I don't think that this plateau and ultimately gradual decline in Chinese construction activity means the commodity prices are going to collapse, right? Because there are other factors there, and we can get into that later. But it does mean that we need, I think, to be a little bit cautious about the medium-term outlook. Okay, let's take a look at technology. And I think the big story here, obviously, is the cancellation of the Ant Financial IPO, which was a huge surprise, and the subsequent push to instigate anti-monopoly investigations into Chinese internet companies, in particular Alibaba, which is the big kahuna of the Chinese internet industry. So I've listed here, all the things that they've done. What I forgot to put in, sort of a crucial thing, which is that in addition to canceling the IPO of Ant Financial, the government accelerated the rollout of pretty stringent regulations on internet finance companies that limit their activity, their ability to originate loans and lever up. So there's been a real regulatory constriction on the fintech sector specifically, and on Ant in particular. And there's been this sort of broad move to, crack down on the internet companies. What's going on here is complicated, but I think you can essentially boil it down into two baskets. So I think there is a set of technocratic objectives and there's a set of political objectives. They're both operating at the same time. So if you look at the technocratic objectives, and you imagine yourself just being sort of a mid-level regulator at the Chinese Cyber Agency or at the Banking Regulatory Commission, you have very good reasons for wanting to rein in the activity of some of these big internet companies. And if you look at what Ant was proposing, what it actually has been doing, and it was what was proposing to do more of after the IPO, it looked a lot like what was going on in the United States financial sector in 2005 to 2007. So what their business model was, they work with banks, they help the banks originate a lot of loans, they generate a lot of leverage to do this, and then they take the loans off their balance sheet and they either sell them to the banks or they securitize them and sell them on the bond market. And the volume of activity of lending that Ant was doing was, as revealed in their prospectus, was more than double what the regulators were previously aware of. So when Ant released its prospectus, it became clear to the regulators that Ant was much larger and had potential to grow much more quickly in ways that were potentially systemically quite risky. So personally, I'm actually kind of with regulators on this. I think they were right to suspend the IPO and get a handle on things rather than allow this kind of unbridled innovation to go forward. And then similarly, if you look at the internet sector more broadly, e-commerce and so forth, Chinese regulators are dealing with the same issues that regulators in Europe and the United States are dealing with in terms of these giant quasi-monopolistic internet companies that have enormous market power and are able to scoop up huge amounts of user data and aren't very accountable for how they use that. So there's a whole set of how do you regulate the internet concerns that are essentially the same in China as they are anywhere else. And that's part of what's going on here. And really what's extraordinary is that, China is a authoritarian system run by a paranoid communist party that wants to have control over everything. And what's amazing is that these internet firms have basically been allowed for 20 years to do whatever the heck they want with very little oversight or control. And so given the nature of the system, it's actually surprising to me how long it has taken for the political system to come in and say, wait, let's not get ahead of ourselves and let's regulate things more carefully. So that's the technocratic side. The political side of this, I think, is twofold. First of all, Jack Ma, as you know, gave a very ill-advised speech in late October to a financial forum in which he basically accused the Chinese government leadership of being dotards and senile old men who didn't know what was going on. This enraged Xi Jinping and has led to a specific political campaign to rein in Jack Ma, and in particular his major company Alibaba. Right. So there is Alibaba is the focus of a investigation that has technocratic elements, but is also very heavily politically driven. We don't think at the moment, I mean, it's kind of up in the air, we don't think that Jack Ma is going to go to jail. There have been comparisons between Jack Ma and Mikhail Khodorkovsky, who got on the wrong side of Putin at the wrong time, and that did not end well for him. My suspicion is that in China, it's not going to quite work out the same way, because the government has a strong interest in giving tech entrepreneurs the message, yeah, it's fine to be a tech entrepreneur. We want you to be a tech entrepreneur. We love these e-commerce companies. We love the innovation that comes out of the internet sector. Just remember who is the big boss in this country, right? So they don't want to kill the golden goose, and by moving too hard against Alibaba and Jack Ma, they could, send a chilling effect through the most vibrant sector of the economy. So they probably don't want to do that. But it was a pretty big political problem, and I think the broader political issue here is that the Communist Party does want to send a strong signal to the big tech companies that, yeah, they are fine to make money and innovate technically, but they should never get into their heads that they have political power on their own and that they can essentially tell the government what to do. So what's interesting is, obviously this hurt Alibaba pretty badly, but they've bounced back quite a bit. And then if you look at, I think the company that is more relevant to you folks, which is Tencent, they've basically done fine. And if you look at the internet sector in China as a whole, what we've done here is compared the 5 biggest internet plays in China, Alibaba, Tencent, Meituan, JD, and Baidu, to a basket of the 5 biggest firms in the US. Both sectors have had their problems this year. But what's interesting was when I first did this chart several days ago, I came up with the first arrows, which if you look at the fall in market cap from peak, which is early September in the US firms, early November for the Chinese firms, the fall was bigger for the US firms than the Chinese firms. So even with all of these storms going on, the hit to the overall valuation of the Chinese internet sector was less than the hit that we saw last fall to the valuation of the US tech sector. And the recovery in the last few days has been even stronger. So now this basket of Chinese internet stocks is now trading at an all-time high, whereas the US basket is still a little bit off its previous highs. So this is just to make the point that, number one, I don't think that we have to fear that this crackdown on Alibaba means that the days of the Chinese internet sector are over. As I said, I think the government wants to maintain this as a vibrant sector. And on Tencent specifically, I think an important lesson is, you may recall, a couple of years ago, they went through their own problem where there was essentially a moratorium on new game approvals. This is their main source of revenue. They had a massive loss. And then they kind of worked through those regulatory issues. There was like a 6-month problem. Then they recovered. And then in the last year, they've just, been ripping. So I think the other point is that this regulatory storm against Alibaba is severe. It's sort of a different caliber than in the past, but it will, I think, pass. And importantly, I think the knock-on effects to companies outside of Alibaba, and in particular Tencent, which is much better positioned from a political standpoint than Alibaba, I don't really see a ton of political risk there. I mean, there are market issues and so forth, but politically, I think Tencent is still in a pretty good position. And just one other point on that, which is if you look at sort of the core financial functions of Alibaba and Tencent, they got their start in payments So each has a payment function. Alibaba's or Ant is sort of more a large ticket item e-commerce payment function. WeChat is more of a low dollar value personal transaction thing. The government has now made specific guidance to the internet firms that they should back off of finance and lending and focus on payments. And Tencent was always much more focused on payments than on the lending side in terms of fintech. So in relative terms, I think Tencent's position has actually strengthened because they are now, their core competence in the fintech sector is aligned with government objectives. Okay, so the final point is on the luxury sector. And this enables me to make some sort of broad comments about where we see consumption going in China. So the basic model we have for understanding consumption in China is this series of S-curves. So basically what each line represents is the number of households each year that cross over a particular income threshold. So the black line represents households with a minimum income of at least $8,000, blue line at least 13,000, red line at least 20,000, and gray line at least $32,000 or $33,000. And what you can see is that there's a wave of S-curves here, that as the economy grows richer, you get these waves of people who suddenly move into new sort of consumption baskets, and they are able to purchase, new categories of goods. And what these income S-curves do is they drive S-curves in particular product categories. So if you look, the black line is sort of entry-level consumers who are buying microwaves and washing machines and so forth. The blue line is basically people who are buying houses and cars, right? And so you have that huge explosion in the Chinese car market. The red line represents people who start to consume services in a big way for the first time. So this is the expansion of financial services, healthcare, education, and so forth. And the gray line is, number one, relevant for you. This is like the sweet spot for people who really go all in on luxury spending, but it's also people who upgrade. They don't add new categories of spending, because once you're in the red basket, you can basically buy in every category. But what the gray people do is that they upgrade to higher price points within each category. And essentially, and this is also what drives spending either on luxury goods specifically or on sort of more brand premium goods. So a couple of observations about this group is that the higher up on the income scale that you go, the better they did during the COVID year. So this chart is a little bit hard to read, but basically the dotted line shows whether you were above or below the previous quarter in terms of your household wealth. And what you can see is that the richest people, their household wealth did not increase as much in Q2 of last year as previously, but they were still gaining wealth, whereas all other poorer households were losing wealth. So the people at the upper incomes end of the spectrum, who are basically in the sweet spot for luxury, these are the people, they were still seeing a net increase in their wealth even at the worst time in COVID. So the underlying pool of spending available for luxury purchases is very robust. Second observation is that although China did not do a lot of income support, there was a big response of increased savings to COVID. Basically, people went home, they didn't spend money. And so saving levels went way up, and you can see that they're still quite elevated. So we do expect to see in China a kind of, over the course of this year, a return to normal consumption activity and so, some pent-up demand effects, and some of this could find its way into the luxury market. And indeed, we in fact saw this happen in the second half of the year. This is the retail sales of jewelry products, and you can see that there was kind of a downward trend, a collapse early last year, huge rebound. It's come off a bit that peak, but I think, given the pent-up savings that exists and the overall very robust income effects that we're seeing at the highest end of the income distribution, we would still see the annual growth in the sales of these kinds of products to be, quite robust in the high single digits to 10% range going forward. And in fact, domestic sales of this may be much stronger because people used to go abroad to Japan or France or wherever to buy these kinds of items, and they may now increasingly do this at home. So I've taken a little bit more time than I intended, but I hope this has been useful. So I will now turn off my slides, and Charlie, it's over to you to feed me some questions.
That's fab. Anyone can put in questions on the right chat, and also happy to take them if you Bloomberg chat your sales guys, or potentially I'll get a chance to look at that as well. I thought that was brilliant. There's a few things that jumped out. First, when you talked about the quasi kind of monopolistic internet story having some similarity to what's going on in Europe and the States, one of the interesting themes that I think we're going to see, or may well see in the next 5 years, is a kind of an attack like America 100 years ago with Roosevelt on those monopolies, and the breakup of Standard Oil or whatever.
Right.
Is there any risk of that in China? Is that something which conceptually they feel there's a lack of competition, or these companies are just too big, or something which could affect regulation and encourage a breakup? Do they ever go down that route?
I think historically they have not. Generally speaking, the view in China is bigger is always better. It's a big country. People think big. They like big. That's certainly the view that they've taken in the last decade on state enterprises. So there had been an effort to kind of, in the 1990s, to break up the big state line ministries into competing entities, and the trend has actually been to reconsolidate the state sector. Now, of course, if companies are in private ownership, that's a different issue, because the party is always very suspicious of concentrations of private power, because they see a potential political risk there. But at the end of the day, if you look at Ant, what's interesting is that although the regulators had these technocratic concerns about financial risk and blah, 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 they didn't move against Ant until Jack Ma made his very ill-advised speech, which suggests that if he had just kept his mouth shut, they probably would have let the thing go forward. And there was a lot of enthusiasm for this, because remember, this was going to be the biggest IPO ever. It was a Chinese company taking basically global leadership in an exciting new field. There was a lot of national pride in this fact and in this company. And I think the Chinese state wants global champions. They want companies that are large enough to compete globally. Huawei is basically a private company, but it's enjoyed huge state support over the years, and achieved essentially a quasi-monopolistic position within the Chinese telecoms market with active state support. And part of the reason for this was that the government wanted Huawei to be big enough and strong enough so that they could actually compete globally. I think that is true for these internet companies. And remember, Alibaba in particular has been a leader in certain kinds of innovations that have been, aligned with state objectives. So in terms of stimulating rural consumption, they set up these kind of what they call these Taobao villages. The payments functions, both in Alibaba, in Ant, and WeChat, I think are very well appreciated. When I was in China, I had an app on my phone which checked my health status, right? So to get into my office building, I had to, input data into my phone, which told me where I'd been the last 14 days. And, that determined whether I was safe to go in. There were two apps, one by Tencent and one by Alibaba, right? So these guys are fully integrated into the governance apparatus of the state. So I just do not think that a breakup is on the cards, and there are too many things pushing in favor of these companies getting bigger. I think what there is an effort to do is have the regulators come in and essentially give these guys slaps on the wrist and saying, don't beat up on your vendors, don't abuse your market power, be a good boy, we'll fine you a little bit of money if we catch you out. But I think fundamentally they see the internet and the companies in it as positive forces. They just need to know their place.
Do they pay enough? I mean, Singapore went for that model, and we're going to pay our technocrats, our bureaucrats so well that they actually know what they're doing. Do the Chinese allow their regulators to get paid well enough, or do the companies constantly find a way around it?
Well, no. I mean, China has not followed the Singapore approach. I don't think they will. I mean, they are a communist country, so the idea is that when you're in the government, you are not there to get rich. You're there to, do public service.
Right.
I think the way that regulators get paid is in power, right? So the Chinese state is very powerful, and if you're a regulator, you have a lot of ability to make things happen. So I mean, I think the regulators are decently competent, and particularly in the financial sector, I think the quality has been extremely high. But no, I don't think we're going to get to a situation where the balance of power is so much on the side of the regulators that the companies just can't fundamentally do what they need to do to make money.
I just want to ask something about demographics and kind of how households are saving money now. I loved your model on housing, and it just makes me think I want to steal it and use it for India, because it looks to me that that could be just a phenomenal story, given that they're at least 20, 25 years behind China on a lot of these issues. But in 2023, India, I think, overtakes China in terms of the biggest population in the world, which talks to a lot of the points you're getting at. And they're an aging society now. The workforce is slightly shrinking. I'm just curious, how's that? Firstly, for years it's buy property, and that was the easy thing to do. Are they reaching out? Ed Southey, our head of sales down in SA, was just asking, have they played a role in the price moves in tech companies? Are they punting in stocks? And is that going to get much bigger, and perhaps how much bigger? So
that's
that, and pensions, and to what extent pension provision is enough. I guess those are the angles I was looking at. Yeah,
so there's a few interesting questions in there. Let me unpack this. So first, let me gently pop your India bubble. We've done quite a lot of work on India. We're structurally pretty bullish on it, but after exhaustive research, we have come to the conclusion there's just China's a one-off. Even just because you have a big population doesn't mean that you're able to mobilize resources in the same way. China has, been able to invest at over 40% of GDP for basically 2 decades. India, never has been able to manage that. And I think the other thing is that China has always been very good at building ahead of demand and sort of creating new demand because of this building ahead. And India is always kind of in catch-up mode. So yeah, it's interesting, but I don't think, unfortunately, that India will ever be a complete replacement for China. But moving on to China, I think it's an interesting question. So the first observation is that if you go back to that S-curve chart that I showed, you remember the red line, which is people with incomes of $20,000, that started really to explode around 2010. And this is the group that starts to behave exactly in the way that you suggested. They've bought a house. They probably bought, 2 or 3 other houses as investment properties. They're kind of tired of that. And they want other things to invest in. And it is exactly at the moment that that group starts to explode that you see the explosion of the wealth management product industry in China and these financial instruments for people to get, a cash yield, essentially. So the development of China's financial markets over the last 10 years is largely driven by portfolio diversification by households. And so that we were already seeing some evidence of that. Now, it's subject to some restrictions, however. Number one, Chinese households are really not permitted to diversify their portfolios outside of China. So they are forced to keep their savings basically within China. China still has capital controls that they're loosening it up on for inbound flows, but not for outbound flows. Now, what you've seen actually in the last year, there is a mechanism for Chinese people to invest in the Hong Kong stock market via their local, you can invest in an account in a Shanghai brokerage that will then take that money and put it in Hong Kong. And those flows have increased a lot this year. So there is clearly the channel of mainland funds going into the Hong Kong market has been very big. But it's basically impossible for Chinese to do a portfolio investment outside of China. So what this then does is it creates this massive pool of pent-up savings. And some of that goes into the financial markets, but a lot of that still goes into property. And we still see, I think if you look at any Asian economy, be it Japan, Taiwan, Korea, whatever, there's still a strong bias in favor of property as an asset class, much more so than in Europe and the United States. And I think the best explanation for this is that in all of these countries, the legal systems, they vary in quality, but they're not the sort of the security of your title to a financial asset is always a little bit shakier. And so people, I think, just have a very strong psychology that the only really safe investment ever is property. So I think there is always a predisposition to favor property above everything else. And if you have this artificial constraint that people can't move their money abroad, and they want some safe assets, then they're going to favor property, right? So I think the sort of elaborate, simplified answer to your question is, yes, we are already seeing this higher saving of wealthier households feed into a rapid expansion of China's financial markets, rapid diversification of products. This is why every Wall Street company in the world wants to be there, because they see this as a huge growth opportunity. So that's going to be major growth. But I think this sort of background predisposition to property as the safest of all safe assets, that's probably a permanent feature of the landscape. It's not unique to China.
Yeah, I think it's a fairly worrying headline when you say that we shouldn't trust the security of title to financial assets when China's 40% of EM. But no, I'm joking.
It's a perception, it's a mentality thing rather than an actual thing, right? It's something that you can touch and feel and walk into.
Yeah.
People are very attached to that. Yeah.
My mother would sympathise. You're not seeing reverse kind of stock raising in Hong Kong what we see in South Africa is certain companies being listed there in order to enable South Africans to get around the capital controls, but actually just invested massively offshore and nothing to do with South Africa at all. Are we seeing that in Hong Kong?
Basically not. I mean, I think a little around the edges, but you may recall back in 2015, 2016, there was a pretty major problem of capital flight. The main vector for that was outward direct investment, so-called, some of which was strategic, but a lot of which was just like company founders trying to get their money out. Those loopholes have been closed. And I think the coordination now between the Hong Kong regulators and the mainland regulators is tight enough that if they saw any sort of large-scale efforts by people trying to move money out, essentially via the listing mechanism, that they would crack down on it. So no, I don't think that that's, it will happen. There will always be cases, but I don't see that as a phenomenon with kind of macro significance.
I've got two major questions still to ask, and we've got about 7-8 minutes to go. If anybody else has a question, just jump in. But one's a risk, and one's about kind of America and relations with America. And perhaps we don't want to end on the risk. So I'll do the risk first, which is that when I first came to see you 10 years ago, I was trying to work out when might it all go wrong for China. And I'd spent a few months in the LSE library looking at Japan and looking at the overinvestment story for decades. And decade after decade, people kept on saying it was going to blow up. When it did blow up in Japan, it was after a trade war that had been going on between Reagan and Japan for 8 years. It was after a massive appreciation of the currency in Japan from roughly 200 yen to the dollar to about 100. And that led to very low interest rates domestically, and that led then to an inflation surge, and then they raised rates and threw themselves up. In brief. And when I saw you, I also saw the central bank, and they were obsessed by the Plaza Accord. And that period of Japanese yen appreciation and how it blew Japan up, and they were determined to avoid it. When people ask you, and you've been asked so many times over the years, what's the biggest risk? What's the risk of a crash? Where's it going to come from? What do you say?
Basically, what I say is that you should stop, waiting for the crash, because it's not going to happen, right? That's not to say that bad things can never happen, right? Bad things can definitely happen, but the issue is like, what kind of bad thing, right? And I think, and it's quite natural, because if I think most people who approach China do so from an emerging markets mindset because China's an emerging market. And the story of emerging markets is that they blow up, and this is pretty much, and you don't even have to be an emerging market. You can be Japan and have that kind of a blow up. But I think China is different because they have figured out how to control and manage the economy in such a way and insulate the financial sector. They've been obsessed with financial stability for decades. And they have an enormous pool of domestic savings. They don't rely on external capital. So the classic emerging market story is one of a current account deficit, reliance on foreign capital inflows. Something goes wrong, the foreign capital dries up, and you're dead. And China basically has ensured that they will never be in that position. As you pointed out, they have been obsessed for a long time with not repeating the mistakes of Japan in the 1980s, and in fact, they've managed their currency very well. And they've had some appreciation, but it's been very gradual. And as you can see, just from the chart that I showed up, they're very canny about managing the trade-weighted exchange rate so it doesn't get out of control. And they have very clear limits on that. And they're big enough to be able to go tell the U.S. to, stuff it when they come complaining about the currency, which Japan was not because they depended on the U.S. for security, right? So I could go on, but basically I think the Chinese system is deliberately constructed to minimize the risk of a dramatic blow-up. But what that then creates is it increases the risk of a long, slow stagnation because you've built in so many buffers and controls, and you are so dependent on this high investment form of growth that you can wind up with a situation where you've invested tons of capital in in ever lower productivity investments, and you never blow up, but growth sort of grinds lower, and after 20 years you find yourself, oh, we have no growth and we have debt of 500% of GDP, and that's where we're going to be forever, right? So that, in terms of what could go wrong in China, I think that's the better way to look at it, that rather than waiting for the crash to come, it's like, what are they doing to offset the momentum towards long-run stagnation and sclerosis, right? That's the game. And their bet, as I said, is we're going to invest in all these new high technology sectors. We're going to get lots of productivity from high tech. It'll be great. So yeah, we'll waste a lot of money, but the gains will outweigh the losses. And you could easily see that going wrong, and they waste a lot of money on a lot of stuff that doesn't work very well, and they have huge debt and no growth to show for it over like a 10 or a 15-year period.
I do have a question, and I don't understand it, but did you see any risks to the VIE structure?
Oh, yes, good question. So these are the variable interest entities that were used essentially to get around regulations on foreign ownership in the Chinese internet sector. I think the answer is no. That has proved, a pretty durable mechanism, and it always gets looked at. But I think fundamentally, that's something that has to occur if Chinese internet companies are going to, continue to attract international capital, which I think they'll have to do, even if they have to move their listings from the U.S. back to Hong Kong.
Okay, and I don't know. We've got probably 2 or 3 minutes, but I have to ask about Biden. How's this going to play out? I have a dream. No, not that sort of dream. But I have a dream that maybe there's tariffs come off in return for China giving something else. What could a sort of deal be? Obviously, there's a lot of issues the US has with China in many areas. This hasn't just been a trade war issue anyway. But where can we see an improvement in relations?
Well, I think, this is like the $64,000 question. I think the short answer is, if you look at what the Biden administration has both said and signaled, the message is pretty clear. Number one, first 6 months, we're not going to change that much, right? We're going to leave all the Trump stuff in place. We're not going to make it worse. We're not going to throw in more tariffs or export controls, but we're not going to roll anything back. Basically, because we have other fish to fry. We have to solve COVID. We have to get our economy back in order. China's kind of back burner. And, why should we roll this stuff back unless the Chinese give us something for it, right? So that's message one. Message two is we're going to work a lot more with our allies, not be so unilateral, and figure out ways where we can put joint pressure on China to, change its practices on, you know, market access or intellectual property protection or whatever. Now, I think they definitely want to have, on a longer view, they want to have a more constructive relationship with China. They want to peel back some of these restrictions, but I think they'll do that very carefully. The politics of this in the U.S. is a minefield. Negativity towards China is at all-time highs. All the Republican candidates for 2024 are lined up on an anti-China thing. So you can't really, in Washington, be seen to be nice to China. So you're going to have to be very selective. So I think broadly what we're going to see is status quo, some adjustment, reopening of some communication channels, some negotiations, a less sort of hectic, bombastic approach. And I think that basically will be good because it introduces more predictability into the investment environment. People can like price the risks much more accurately. And then I think finally that they will try to find some specific ways, I think notably on climate change, where they can figure out a way to do something alongside, you know, constructively with China. So they will try and keep up the pressure, I think, in a lot of the ways that the Trump administration did, but they'll have a more balanced portfolio of positions, which will include some cooperation. And I think that the scope for cooperation on things like renewable energy, harmonization of carbon taxation and trading regimes and stuff like that, there's actually a lot of stuff that you could do, and you can do it in a way that doesn't make it seem like you're selling out to China. But it's going to be a long process, and I think the short answer for this year is don't expect too much of a change, just expect a lowering of the temperature.
And if I can ask one last question, very short.
Sure.
If you had to put a guess on where the currency is at the end of the year.
Oh, I really hate doing that. You know, and if those guesses were any good, I would not be wasting my time talking to you guys. I'd be like on the beach somewhere, you know, enjoying my ill-gotten gains. But it's a question of you know, which rate you're talking about. So the problem is, if you're talking about the renminbi dollar rate, that's a function of what the dollar does more broadly, and basically that's a function of what the dollar does against the euro, which is almost 60% of the DXY basket. Our house call, my European economists tell me that we're on pause right now, but the euro should actually strengthen a bit more to the end of the year. So our target there is 125 for dollar euro. So if that happens, that implies that the broad dollar index weakens a bit more, renminbi dollar strengthens a bit more. You know, so right now we're at what, 6.4, 6.5. So you could get maybe up to 6.3, a little bit higher, not much more than that, I would think. But this would be in the context of the trade weighted exchange rate being more or less at the current index level. So I would say fundamentally, renminbi is firm on a trade-weighted basis, not much up, not much down, potential for some further modest appreciation against the dollar, depending on what dollar-euro does.
I also hate those questions, but it feels like at the end of the day, it's fair enough that this is what investors, they need to have something to work with.
For sure,
and that number's not too controversial for me either. So that's great. Arthur, thank you so much for your time.
Okay, my pleasure.
I really appreciate that. I learned a lot again, and I will look forward to seeing you again in some other forum.
Okay, hopefully not. We won't have to wait 10 years for the next one.
I hope not. Take care.
Okay, great. Thanks so much. Right, bye-bye.
Bye.